raises fundamental questions for those, Tom, who are dependent upon us for their security. They look at us and they wonder, is that a wise choice? Let me give you mentioned some of my previous books. The book I'm writing now, Tom, is on what you're talking about. It's on America's domestic turmoil, on the threats to American democracy. I actually think the greatest threat to our standing in the world, to our standing at home, is not China or North Korea or Iran or Russia. It's ourselves. So foreign policy does begin at home. It doesn't end there. It begins here. And right now, our base is extraordinarily weak.
Well, then how does the moderate take the high ground? I mean, we're advantaged here, Richard Austin, that John Farrow looks at the zaniness of what we're dealing with here every day. We look like we're on another planet. How do we rediscover the middle ground of American politics?
If I had the answer to that, Tom, I'd put it out there and I'd try to bring it about. I think there's things we can do over time. A lot of talk about renewing civics education. Americans don't understand why democracy is valuable, what they have to do to make it. But we're also going to need some profiles and courage. Kennedy's book needs to find some new people to live it. Like the Republican performance on the debt ceiling was really disappointing. The Mitt Romneys, the Rob Portmans. Why are these serious centrist Republicans following an irresponsible path? I do not understand it.
Richard, how do you talk about the idea of globalization as being a positive thing at a time when there are increasing supply chain disruptions, when you have some of the consequences of globalization still impeding a labor market, or at least that is the perception here in the United States?
I mainly see globalization as a thing. It's both positive and negative, and the challenge is to push back against the negatives and take advantage of the positives. I think trade is blamed for all sorts of problems, which are really about productivity increases, about technology, innovation. People haven't done a good job of explaining it, but that accounts for the fact that we don't have a trade policy. The head of the U.S. Trade Representative gave a speech the other day. It was essentially, it could have been given by a Trump administration official. Meanwhile, the United States is not doing anything to reform the WTO. We're not participating in the principal trade agreement in the Asia-Pacific region. We are hurting American workers across the board. We're hurting ourselves strategically. So we pay an incredible price for this rejection of globalization, quote unquote.
Richard, thank you, sir. As always, great to have you with us on the programme. Richard Haas there, the Council on Foreign Relations President. Just to weigh in on this energy story, Halima Croft of RBC. Lisa mentioning earlier in the hour the comments from Secretary Granholm, the Energy Secretary here in the United States, on the possibility, I stress possibility, of a release from the Strategic Petroleum Reserve here in America. Halima Croft, Tom, saying the following: these comments were clearly aimed at trying to incentivize Saudi Arabia and its OPEC Plus partners to put more barrels on the market.
Halima's been on fire in the last number of days on his folks. This is like, John, it's like set your watch. You're going to come up with a strategic reserve. I can't remember the dynamics of that, but to me, I'll be honest, John, to me it's a sideshow. Although we did learn decades ago it can move the market, which is what Halima's alluding to. Halima says at some point, as she calls it, the central bank of oil will step in.
Well, they haven't stepped in a big way yet. Lisa, Halima Croft going on to write with her team the following: the remarks from her reflect a growing concern in the White House that, quote, a perilous run-up in prices could derail the global recovery.
They could derail the global recovery. They could also derail the 2022 chances of the incoming class.
That's the point, isn't it?
I mean, that's the point. I do wonder if gas prices at $3.19 a gallon will derail the global recovery. Is that what we're talking about at a time when Morgan Stanley analysts point out the reason why gas prices are going up is because demand is going up? There is some positive side to this story.
It goes to something Francisco Blanche talked about of Bank of America, though, Tom. If we had triple-digit crude, he's got base case, something in the region of the middle of next year. What does that look like going into the midterms?
It looks like going into the midterms, 3.XX per gallon. I'm guessing 58, John, was the old average, inflation adjusted. You get up $3.80 a gallon. Maybe in some of the fancy parts where you live, John, you get up to $4.10 a gallon. That's what it means for the elections.
One day we'll share addresses live on air and people can work things out, Tom.
They can triangulate that.
Halima Croft.
When was the last time, John, you drove a car?
I drove a car. 18.
When you were
Like that.
18 or 2018?
No, I was 18.
No, I wonder if I
Maybe
could drive
I was a little
car
bit
today.
older. I think there were some L plates on it.
When we go on a road trip, I'll be the driver.
I'll drive. You sit in the other seat.
Yeah.
Great.
Yeah, we drive on the other side of the road. Come on.
150, 189 on 10s. Crude 76.20.
I still think you could do
Negative
Daniel
1.6%. Equities up 29, advancing 0.7%. It's Thursday. You're almost there. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The Senate is closing in on a deal that would avert a potentially devastating default by the U.S. For now, Democrats appear to be on the verge of accepting a proposal by Senate Republican leader Mitch McConnell to push the debt limit into December. Then Congress would have to vote again to avoid a default. Bloomberg's learned the Biden administration is debating the fate of IMF Managing Director Christiane Georgieva. She's been caught up in an ethics scandal from the time she was at the World Bank. The U.S. is the IMF's largest shareholder and could ask Georgieva to resign. The fund is reviewing an investigation conducted by a law firm. And Bloomberg's learned that the European Central Bank is studying a new bond buying program. It would be used to prevent market turmoil when emergency purchases get phased out next year. The plan would replace the existing crisis tool and complement an older quantitative easing scheme. Home prices in the UK rose last month at the fastest pace in 14 years. According to Halifax, the average price of a home climbed 1.7% to $363,000. The annual rate of growth increased to 7.4%. Halifax says the healthy demand for housing is likely to persist despite some economic headwinds. Most shoppers plan to use buy now, pay later loans in the next couple of years. That's according to a report from Capgemini that highlights the surge in new financial products. Fintech firms such as Klarna and Afterpay offer customers the option to pay in installments when they shop online. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
People don't know who to believe, what to believe, where to go for good information. There is a crisis of misinformation that leads to people making poor decisions. And poor decisions drive infection.
Dr. Bhakti Hansati there of Johns Hopkins from New York City this morning. Good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Do you remember the middle of March last year? March last year. Tom, if I told you we'd still be talking about it in October 2021, what would you have said? But here we are.
It's a really, really good point. I guess I'd say, John, with my limited knowledge, yeah, we'd still be talking about it, but would it be like it is right now? No, absolutely
The President of the United States at the time was shrugging it off. You had Democrats in New York City. Do you remember Mayor Bill de Blasio? Get out on the town. Get out on the town. Shrugging the shoulders here too. And here we are, Tom, still talking about it.
Let's do this, and this is a really important conversation, folks. Lisa, John, and I all feel we're not going to play amateur doctor. We're going to talk to adults about the issues at hand. David Dowdy is an adult. He's at Johns Hopkins Bloomberg School of Public Health, but he's much more than just an epidemiologist. He's someone with an international perspective and a holistic knowledge of the research at hand. David Dowdy, I want to cut to the chase, and our Jason Gale kills it today at Bloomberg on cardiac research. This is the follow-on 6 months, 1 year, or we don't know what the internal medicine blood ramifications are of this odd pathogen. What is it going to be? Do we know yet what the cardiac complications are?
We don't know for sure, but what we do know is that the overall rates of these sorts of cardiac complications are pretty low. So what we really need, unfortunately, even though it is a month and a half or a year and a half in, we still need more research to figure this out.
The percentage numbers are there, and we can all do scientific notation, 10 to the minus whatever. Forget about the math of it. People are going to compare cardiac internal medicine complications to, say, the flu or a cold or pneumonia. Are they equivalent, or is this much worse?
It is worse. It's substantially worse than the flu or the cold. Pneumonia depends on what kind of pneumonia you're talking about. But we can draw the comparisons all we want. This is still a more deadly and a more serious infection by far than just the flu or the cold.
And Dr. Dowdy, this brings up long COVID and what we know in terms of how long COVID lasts, how prevalent these long existing symptoms are. What's the latest on that?
So the prevalence of these symptoms depends on who you compare it to, but it's certainly a real thing, and certainly at least 1 in 10 to 20 people experience these symptoms beyond 3 months. How long it lasts, we're still figuring that out. The longer you go, the fewer symptoms there are, but it definitely persists, and for some people has persisted as long as we've been tracking their symptoms.
Meanwhile, Dr. Dowdy, it is getting cooler. Kids are back in school for the most part, and they are starting to expose each other to whatever germs they have, despite the best efforts to keep their masks on. Are illnesses that are not COVID more severe because of the 1-year hiatus between getting infected with anything? Are our immune systems down so much that other illnesses can have a more severe impact?
So it's probably not because of the immune system being down, but rather because our immune systems haven't seen these things for a year and a half because we've all been hunkering down. It's possible. We don't know if things like the flu are going to be more serious this year, but it's definitely a possibility, and it's something we're keeping an eye on. It's all the more important to get that flu vaccine this year.
Is Delta fading away? Is the Delta virus fading away? I think it was the India virus before it was the Delta virus. I can't remember now. But, you know, I look at the maps in the Washington Post, the New York Times, Bloomberg, the wonderful FT work, great. Can you say we've really rounded the corner?
I think we have rounded the corner. It doesn't mean that there's not another surge in front of us, but cases are definitely going down. And all of those cases are Delta. So I wouldn't say it's fading away. We're still at about 100,000 cases a day, so it's still a big deal. But it is going down, and it looks to be a real trend.
Where are we on masks? I was on Fifth Avenue yesterday, and I noticed for the first time a real dearth of masks out there. There were a lot of people walking around without masks on in a very fully vaccinated New York City as well. Where do you stand on masks, Dr. Dowdy?
Well, I think right now we're still seeing enough transmission that it's still a smart thing to wear masks. It's more important indoors than outdoors. But I think we're still in a place where we need to be keeping those masks on.
Dr. Dowdy, I got to be honest. People are getting sick of COVID. We're kind of done with this, and I'm wondering how long we can have to sort of keep going at some of these same topics again and again at a time when we do have prevalence, but hospitalizations are going down. When can we stop?
Yeah, well, I think I'm sick of it too. But I think that we still have a little ways to go. I do hope that this surge might be the last big surge, and we might be turning that corner. So there's reason to hope that in the next 2 or 3 months we're going to be back down to where things were before. Though no one can ever say for sure. I do think that we're going to be living with this for, at some level for many years, but hopefully not at the kind of, to where it's going to be making on your news stations all the time.
That was the face for man that's been asked that question about 1,000 times in the last 24 hours or something. Doctor, thank you. We appreciate your time, sir. Dr. David Dowdy of Johns Hopkins Bloomberg School of Public Health. That will be the ultimate test, Lisa. Whether these daily conversations go away.
Exactly, that will be the threshold for which
we've got to know these guys really, really well, and they're fantastic. We all agree. They agree too. They want to stop coming on.
100%.
They want this to go away.
And they're exhausted. I mean, honestly, everybody who works in the medical field is exhausted with this. And frankly, the idea that they have to keep repeating, wear a mask, be prudent, keep your distance, be logical, take your risks. I mean, it's frustrating for everyone, but here we are.
Tom, next big test, we all start to go inside for the colder months ahead in a northern hemisphere.
To me, the next big test is, do the politicians have the vibrancy and courage? We talked to Ambassador Haas about profiles and courage. Do they have the profiles and courage to step up what seems to be working, which is get vaccinated?
Travel. Travel started to change as well, Tom.
Yes.
That started to change, international travel. That's encouraging, though. I haven't seen a firm date, have you? On opening things back up.
John, I
defer
to you on that.
America. I haven't seen a firm date. We were told early November.
Well,
I haven't.
We're not there
I might be
yet.
wrong. If someone can reach out to me, give me that firm date if they've got it.
John, just as one example, I'm looking at train schedules in Italy, and they don't go to the end of the year. There's a mystery.
I'm looking at train schedules in Italy too, John. How about you?
No, but as one example.
Well, Lisa, he's been distracted through the first hour of this program.
John,
revealed what he's been up to. Yes, Tom.
3-day weekend coming up. I may go below 50 nights.
Have you got a 3-day weekend coming up?
Yeah.
Are you taking tomorrow off?
I don't know. It's
Monday
one of those days off. No, I'm not. I'll be here for payroll.
When's the 3-day weekend coming up for you?
Like Columbus Day.
All right,
like,
okay.
Nina, what do we? There's a new name for Columbus Day now, or something.
Tom Keane, Lisa Bravitz, Jonathan Ferro.
It's an
I think
American
it's Indigenous
holiday,
Peoples
John.
Day, Tom.
John, can we
think
talk
you know that
Newcastle
too.
when we come back?
We can, if you're not in too much trouble. Up 32, we advanced 0.75% from New York.
What's the threshold?
This is Bloomberg.
Something wrong with her eye. When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah. Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
The August jobs report packed a big downside punch.
That is a really, really dismal number.
Will September bring enough good news for the Fed to start a taper?
If progress continues broadly as expected, a moderation in the pace of asset purchases may soon be warranted.
Will unemployment keep going down? And what's happening with wage inflation?
It might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
Tune in for the September jobs report, Friday on Bloomberg Television and Radio.
The problem isn't inflation too low, the problem is inflation too high.
Yes, inflation is going to become more problematic, but not problematic enough for stocks.
If inflation risks persist, you're going to see room for break-evens to continue to rise from here on.
It's going to be very wobbly because there is elements here that we're dealing with stagflation.
There's also this idea that higher prices ultimately become a solution to higher prices.
This is Bloomberg Surveillance with Tom Keane, Jonathan Farrow, and Lisa Abramowitz.
A little bit of calm before a payroll storm from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keane and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive 0.8%. We advanced 36 points. A can kick set up down in DC, Tom. Some soothing words in the energy market and a little bit of stability this morning.
It's a draw up this morning. We made a joke about it in the last hour. Let's do it again, John. Drawdown, gloom, and all that. You know, institutions solved the problem. The institution of the gentleman from Kentucky solved the problem. The institution known that Mr. Putin in Moscow solved the problem.
How sustainable is everything you've just said, Tom? That's the question for me.
Fear and gloom. I'm in triple leveraged all cash. I don't care.
Thanks for participating this morning, Tom. Lisa, what is going on here?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. Have we shifted now to, no, it's not stagflation. It's not that bad. Oh, and guess what? Policymakers are so concerned about keeping everything going the way that they are, that they will step in at the slightest turbulence.
It's a lovely bounce this morning for the equity bulls. Let's run through this as Tom works through some issues. We're up 39 on the S&P. We advanced 0.9%. No idea what's going on in there. Yields unchanged on 10s at 151.72. Here's the turnaround in crude, and what a turnaround it is. We were seemingly approaching 80 at one point yesterday morning. 76.28. We're negative there, 1.5%. I talked about the soothing words in the energy market. We had Vladimir Putin talking about natural gas, and Secretary Granholm here in the United States talking about potentially releasing some crude, Tom.
Well, this is really, really important, John. We got to stop right here because smart people are coming out and saying the analogs to the past aren't there. Carl Weinberg, HFE, with huge experience, says it's not 1973. That's all there is to it. And I love what Ben Laidler said this morning, John. We are a decommoditized society. We're not living in the dismal 70s.
I'm pleased you're back in the game. Just a couple of minutes late, Tom.
Well, I just was. I saw the Red Sox lineup for Tampa Bay, and it's not working.
You were clearly distracted. Euro dollar 115.62. Unchanged this morning, Lisa.
Yeah, right now we're looking at a bit of stasis ahead of that big payrolls report that we get tomorrow, as you were talking about, John. And the drumbeat gets louder at 8:30 a.m. We get the U.S. initial jobless claims. Very curious to see how much they do continue to go down, given some of the supply chain constraints that you've seen. Auto companies in particular have to suspend production and actually do temporary layoffs. You see that the buying conditions have dropped to an all-time low. Then we get, of course, a discussion on inflation. The jobs market very much dovetails into concerns about how quickly prices are rising, how sustainable this is. 11:45 a.m., Cleveland Fed President Loretta Mester is going to be joining Philip Lane of the ECB at a virtual panel discussing consumer prices that are about the highest since 2008 around the world. Very curious, a Nick Colas quote from DataTrek yesterday showing that the pace of increases in wages would have to remain above 4% for years before you get that wage inflation spiral that creates good inflation. Curious to see what they have to say about that. And today is the final day of the Bloomberg Invest Conference. We've heard about stagflation. We've heard about China fears. Today, how do we move the conversation forward at a time where there really isn't a narrative today? So maybe they'll give us one. Orlando Bravo of Thoma Bravo, as well as, of course, Stephen Mnuchin, former U.S. Treasury Secretary. John.
Lisa, thank you. Great setup for the next 24 hours into payrolls tomorrow. The numbers drop from Ellen Zentner over at Morgan Stanley. They just published, Tom. We expect non-farm payrolls increased by 700K in September. Despite this gain, we expect only a small downtick in the unemployment rate to 5.1%, owing to a bump in labor force participation. We expect average hourly earnings rose 0.4% on the month, lifting the year-over-year rate from 4.3 to 4.6. That report, Tom, just in from Morgan Stanley.
And you look at that, John, and that's a healing economy. Morgan Stanley and others have led on this. What's that glide path, Q3, Q4, et cetera? And what I just heard there is a set of guesstimates that signal a healing America. What's that timeline? We don't know, but it's a healing America, not the gloom of recession.
700K, the top end of the range, 750-ish, the bottom end.
That's
zero.
a big number.
We'll catch up, I think, with Ellen Zentner tomorrow, and also the guy with zero, Thomas Costa Pictet.
Yeah.
Tom, he'll join us tomorrow morning too.
And John, what's so important here is we need to remind ourselves that the run rate long ago was 150,000 a month. So that's a big number.
Now the run rate is we have no idea.
We have no idea.
Every single month.
No
Kathy
clue.
Jones joins us now. Schwab Center for Financial Research Chief Fixed Income Strategist. Kathy, let's start here. I always read about the end of easy money. You talk about it this morning too. What does that mean, Kathy?
It just means that we've peaked in terms of, or we're close to peaking in terms of the amount of stimulus we're getting from central banks. And as we look down the road, that's going to ebb a bit. It doesn't mean it's going to crash and burn. It doesn't mean it's going to have, this huge catastrophic impact. But it does mean as we look forward, we're looking at financial conditions about as easy as they've been in a decade. that narrative will start to change, and we'll start to see, this stimulus, this excess stimulus perhaps that we've been getting is going to move away. And that's what the markets, I think, have to adjust to over the next 6 to 12 months.
Is tapering tightening, Kathy? I ask this because tomorrow will be sort of a key determinant about whether November really will be the month where we hear about the plans to taper and maybe it begins.
No, absolutely not. I mean, the balance sheet is going to continue to grow. We've projected it out to about $9 trillion by the middle of next year, when the Fed presumably will be done with tapering. So the balance sheet's still growing. That keeps financial conditions really easy. We don't expect a rate hike until late 2022. So tapering is not tightening, but the signaling is important here. What we've seen in the past is when the Fed is tapering, you actually see the Fed is in asset purchase mode. We've actually seen yields rise and the curve steepen, because part of the signal is that they're pushing a lot of easy money into the system that should promote economic growth and inflation. As they taper and start to take that away, yields have tended to peak and will start to come down. So once QE ends, we think that the peak in yields will probably be with us. That's probably the middle of next year.
Okay, so this is actually really counterintuitive. That tapering will lead to lower yields because it indicates perhaps a slower future because they are removing some accommodation. However, this time, some people are saying is different because the removal of accommodation, the pace of bond purchases around the world, central banks globally, are all coming down at the same time. How much does that remove demand internationally that sets a very different scene?
Well, domestically, at least, we're not worried about that because Treasury issuance is going to go down more than the Fed is withdrawing in terms of purchases. So net issuance in the United States is set to decline next year. So we're not worried about the demand side, replacing the Fed purchases. I think globally, that's probably not going to be an issue either because look, we're not really in a position here where if you're an institutional investor or a pension fund, an insurance company, whatever, that needs long-term assets, you're still going to be buying those. So we're not too worried about the on the supply side.
Kathy, I just did a quick look at the inflation-adjusted 5-year yield, which maybe is a retiree proxy. Schwab works with a lot of retirees. Can you explain to me why they should own bonds if they have seen a negative 5-year real yield since July of 2010? It's been essentially 11 years of no return clipping coupons.
Well, actually, Tom, I would argue that there's been a positive return in 5-year if you're reinvesting the coupons, right? So it has been a positive real return, but you're right. We've been suggesting lower duration for I don't know how long now because those yields are so low. And we're certainly not suggesting everybody go all into negative real yields in their retirement portfolios. Usually the way we look at it is you have a balance of assets. And the fixed income assets are there for that capital preservation, to reduce volatility, to have some of that diversification from equities. And that still works. And in fact, even when we look at the role of treasuries, the lowest yielding, and say, well, should we substitute other assets for that in asset allocation? It's really tough to find something that will offset a significant decline in the stock market other than treasuries. So there's still a role for it. We'd like tips. We'd like, a total return approach in portfolios. We've told people that they have to rebalance frequently and sometimes use the whole portfolio to generate income. So there's a lot of strategies you can use without exiting fixed income entirely.
Kathy, we like you and we appreciate your time. Thank you. Kathy Jones, Schwab Center for Financial Research on this bond market. Looking at the forecast quickly, BYFC on the Bloomberg terminal, if you do subscribe, on a 10-year, year-end now, it's 159. You have to look to Q4 22 for something close to 2% to kick in. Based on a forecast here, Tom, 199 year-end 22.
We're all guilty of this, John. We don't talk enough about what all this Bloomberg blather means for retirees and for retail out there, other than the fixation on equities. I get all of that. John, an intermediate term corporate bond fund, the last 11 years has generated 5% per year.
Yeah.
You take out inflation, I'm going to take the point of Kathy Jones, that is a positive real return. But John, the CFA word here is teens weens.
It's helped you out, though, in some tough times. Let's be clear about that, Tom. I get what you're saying, but if you think in terms of total return, capital returns, there's been some big years in the mix for the long bond over the last 10 years. Now, if you're just sitting in it, granted, I know what you're saying. I'm just saying there's been some big years in the mix, too.
We do the math in real time here in surveillance.
He's having a hard
I can tell
time.
your mind's ticking over.
Because it's still in triple
Standard
overall
&
cash.
Poor's is up 24%, so it only won
Tom,
by 1,900 basis points.
I get it. I'm with you.
Did I do okay?
You're fantastic,
Okay,
TK.
I'm
It's
focused.
okay. You're a wonderful man.
We
all love you. Do you feel loved? I'm 39 on the S&P, advancing about 9 cents of 1%. Session highs. I'll come in there and give you a hug.
John, Tampa Bay is so good.
I just don't know what's going on. On radio, on TV. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Democrats are signaling they'll accept Senate Republican leader Mitch McConnell's offer to raise the debt ceiling into December. That would avert the immediate risk of a default, but it also increases the risk of another political fight near the end of the year. A federal judge has temporarily blocked Texas's new ban on most abortions. He said the law outsourcing enforcement to bounty hunting members of the public was contrived to get around a constitutional right. It's a major win for the Biden administration, which has sued to overturn the ban. Heart damage from the coronavirus extends well beyond the disease's initial stages. That's according to a study from a Veterans Affairs health system in St. Louis. It found that even people who were never sick enough to need hospitalization are in danger of developing heart failure and blood clots a year later. Apple has a new plan for cars. Bloomberg's learned it's working on technology that would allow drivers to use iPhones to control the air conditioning, seats, and radio, amongst other functions. Apple's CarPlay interface is already used by millions of motorists to control music, get directions, and make phone calls. American Express is expanding the perks available to customers of its high-end premium card. One of those will be rewards from discount retailer Walmart. The $695 a year card would one statement credits for Walmart Plus. That's a program that gives customers free shipping for online orders, plus discounts on gas and prescriptions. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
第18条第2項におり本院において内閣総理大臣に指名することにこの際暫時休憩いたします。
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You look
drop
great.
the bow tie. Drop the bow tie.
What? Skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours. And renewables. We have a very strong climate component in our government and in our government programme. And that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Congress does not take action to raise the debt limit, America would default for the first time in history. Recovery would be thrown into reverse. We would likely experience a recession.
We need to resolve this issue very quickly. Every day of delay right now comes at an increasing price.
An actual default would be unprecedented. The effects would be cascading. This is a time I think we should show American competence, not American incompetence.
That was Secretary Yellen alongside Jane Fraser of Citigroup, JP Morgan's Jamie Dimon together to meet the president to discuss the risk of a potential default in America. It looks like DC is getting together to kick that can into December. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity markets bouncing back up 42. DC contributing towards this. We're higher by almost a full percentage point now this morning. Radically different to yesterday morning. Yields unchanged, 152, 110, euro dollar stable, firmer, stronger euro, 115.67, crude negative, weaker, lower, down to 76.39. Crude, Tom, down by 1.34%.
Yeah, I'm glad you're following crude there, $80.37 Brent. John, it's a draw up. John, it's a draw up, 1.2%, massive expansion,
audience, I went into Tom's studio. I gave him one of those European socially distanced hugs, couple of air kisses to make you feel better. Why are you still upset?
Because the Red Sox are going up against the Rays, and the Rays aren't the New York Yankees. The Rays are
you're done. Season
actually
over.
Good.
Season over. Just try and focus a bit, Tom.
That's
just
true. Let's do this, because the last time she's on, we got a ton of mail. She was lights out. Henrietta Trays joins us again with Veda Partners on your Washington Folly. Henrietta, World War I, 1917, the Second Liberty Bond Act, it's their fault. We have a debt limit. Is this debate now the same as it was as we prosecuted World War I?
I mean, I think it's a horse of a different color now, but, you know, we talk about it's maybe bringing it into more recent times, don't fight the Fed, but we learned yesterday, don't even think about getting in the ring with the Treasury. I mean, you're not going to win that fight. We saw the Secretary of State's, the Pentagon, Defense Department, Homeland Security, Jamie Dimon, Larry Gensler, everybody come out of the woodwork. I think Dick Cheney might have weighed in at some point. I mean, they are not in a position to mess around with the debt ceiling. It is not for small-time political football, and they got a very serious message yesterday from all those leaders. It was nice to see some sort of establishment political stuff really function.
Dick Gebhardt in Mourning Over the Cardinals. There was the Gebhardt rule in 1979. What's the Trays rule of 2022? What's the new when we come out of this folly?
I mean, honestly, my mantra is they're not going to do anything until they absolutely have to. So they're going to find ways to get around deadlines. One of my colleagues, Spencer Froman, likes to say they are both the players and the referees in this game of congressional football. And so when they don't want to play a game, they literally just invent a new rule. So the Gephardt rule, there's the Hastert rule. There are a ton of them. And my mantra for this cycle with 50 seats split in the Senate is effectively they're not going to do anything until they absolutely have to. So they're going to kick the can now. They're negotiating something really difficult at the leadership level, which is to figure out how long the duration of this kick the can is really going to go. Tethering the Treasury Secretary to any specific dollar figure or a date is nearly impossible, as we've learned for the last decade. So that's really important to both members. They were up until midnight last night trying to hash out a deal. They don't have one yet. We'll figure that out hopefully sometime today. The Senate will take the vote and then they'll go on recess. Another rule, recesses are very important.
Henrietta, help me out with this, and it's a little bit off topic, but I think it's pertinent. We heard from John Kerry. He's now the special envoy on climate change for this administration. He had some odd comments to say about the President of the United States and insinuated that the President didn't realize how annoyed the French were, didn't have any real awareness of the situation. What did you make of those comments?
I mean, I think that right now the U.S. is doing a very serious balancing act. And one of the things John Kerry has as an opportunity for the first time that he hasn't had in the last 10 months is to really start weighing in on foreign policy. Whereas the Biden administration has been so singularly focused on domestic policy with COVID, with the bipartisan infrastructure bill, with Build Back Better, now we can get more vocal. Obviously, the French have a lot of issues with some of the more recent announcements we've made. And frankly, Secretary Kerry has some need to get more aggressively involved based on, his more recent trip to China. So I think him bringing France to the forefront, especially while USTR Catherine Tai is over there having meetings with foreign ministers in Paris, is a very important timing opportunity. And as I suggested, I think that the Biden administration is going to get a lot more involved in foreign trade and foreign policy as a general rule from the White House than they have been for the last 10 months.
From your perspective, Henrietta, was he undermining the president or Secretary Blinken?
That's a good question. I don't want to necessarily get involved in who he's undermining. I think he himself has felt undermined in a lot of ways for several months now. So I'm sure there's a lot of blame to go around. I think that the administration has a whole bunch of wheels moving at the same time with the EU, in particular on things like the global minimum tax agreement, digital trade, removing the steel and aluminum tariffs, and getting all of those agreements to come up at the same level in a conversation where you can't even get a deal on fisheries and you want to turn everybody's attention to China. I think it's really complicated. So I don't know that trying to shoot any of the messengers on the administration side is in their best interest, certainly not from within inside the building.
Henrietta, it kind of feels like whack-a-mole some days because we're talking about international relations. We're also talking about domestic policy and the domestic agenda, which is facing so many battles. There's this from Transportation Secretary Pete Buttigieg this morning on MSNBC saying that the administration has concerns about truck driver turnover. This comes after the Energy Secretary talked about potentially releasing energy reserves to keep oil prices down, gas prices down. How much is this just whack-a-mole versus a cohesive strategy to try to address some of the labor market frictions throughout the industries that we're talking about here?
No, I mean, it's every calamity at the exact same time. You're exactly right to point it out. And I think everybody has another person down the line to blame, whether it's, the ships that are sitting off the coast of the Pacific, who can't get offloaded, who can't find trucks to unload them, who has to deal with the energy crisis. I mean, it's really never ending. And I think that's a part of why, not to change the subject, but I think that's a part of why the debt ceiling was such a travesty to even bring it up. There are real problems. Whack-a-mole is the perfect term for it. And the administration is trying to tackle it from as many perspectives as possible. They'll tell you first and foremost, give us the infrastructure bill so we can get this spending out, help us, shore up domestic supply chains, grow some production, invest in R&D, figure a way out of this morass, have the $550 billion in additional stimulus to go out, see if we need that money to rectify any of these immediate constraints. But the supply chain is absolutely broken. And they need to fix that along with dealing with energy crises and inflation. So I think a step in that direction would be what USTR Tai announced yesterday via the Federal Register, which is that they're going to start alleviating or excluding some tariffs again. I think we're going to get some material reforms to the U.S. trade relationship with the EU on steel and aluminum tariffs, which will alleviate some of their reciprocal ones, and eventually some movement on the China front. But we can't even get the China bill passed, the Invest Act. So there's a long way to go, and it will take years to sort out of this for sure.
We could talk to you for years. Henrietta, you know that. It's great to catch up. Henrietta Trace there of Veda Partners from New York City this morning. Good morning. On radio, on TV, for our audience worldwide, with futures rallying, equities up 1%. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, port delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
What are you calling this, Tom? A melt-up? A melt-up?
Draw up. It's a draw
up
yeah.
after a draw down.
I'm looking for the birth cross.
Makes perfect sense. Equity futures up about 1% on the S&P, up 1.2% on the Nasdaq, on the Russell, up 8 or 0.9%. All of this following the biggest one-day reversal on the S&P 500, going all the way back to February. We were deeply negative at the start of the session. We ended up rallying into positive territory to close out the day, helped out by what's happening in Washington, but also by this in the energy market. Switch up the board and get to crude and get to nat gas. We had that verbal intervention from President Putin, that verbal intervention from Secretary Granholm here in the United States as well. Halima Croft of RBC suggesting that was a warning shot to OPEC Plus. Get it done. Bring some barrels to market. WTI crude back with a 76 handle, $76 and about 28 cents. We're negative there, 1.5%. Natural gas down by 2.6 percentage points. That's the energy story. Here's the bond market story. Switch up the board and get to the Italian bond market and the US bond market as well. Might we finally see some central bank divergence between the ECB and the Federal Reserve going into next year? The United States right now, we're staring down tapering, 152.24 on 10s. Yields doing nothing today. Yields doing something in Italy, Tom. Yields in 5 basis points to about 84 basis points. I'm going to make it really confusing for you, Tom. The ECB, according to our team over in Frankfurt, studying a new bond buying program to complement the old bond buying program to replace the newer, more recent bond buying program.
What's the so what of that?
The so what is that the emergency bond buying program, so-called PEP, Tom, had a ton of flexibility. That's set to end year-end into next year. What replaces it? And what replaces it needs to have some flexibility to come for this bond market. That's the so what. Do we have that flexibility once the pandemic emergency purchase program ends? Yields in Italy, a nice rally for BTBs. Did you get all that?
It's just, you know.
Do you feel okay this morning? Do you feel better?
It's good.
You feel good?
I'm seeing negative yields come up. German 10-year comes up a little bit. Swiss 20-year is a positive yield as well. So
he's very sensitive this morning, Lisa.
He is.
He is.
He has a little tang.
It's okay, Tom. We're almost there. One more day. Payrolls
I know,
tomorrow.
one more day until the Red Sox confront the Tampas.
The Tampas, okay. 152.24, that's your cross-asset price action, that's your 10-year yield. Let's get you some movers and say good morning to Romain. Morning, Romain.
Hey, good morning, John. And once again, all eyes are on what's going on in the tech space here. Of course, we're getting basically what's now a 3-day rebound potentially here after that big sell-off. Chip stocks really been emblematic of this, Tom. You're talking about the Philadelphia Semiconductor Index, which had a huge drawdown. NVIDIA had a 14% drawdown. It's up 5% over the previous 2 sessions, up about 2% here in the pre-market. A lot of folks realizing that the valuations definitely got maybe a little bit too oversold, at least based on your traditional technical measures. Keep an eye on GM. Those shares up about 1% here on the day. This after, of course, it's Investor Day yesterday. Mary Barra basically doubling down on that pledge to double revenue to $280 billion by the end of the decade. A big component of that, of course, is going to be the Cruise, the self-driving car unit. That unit expected to contribute about $50 billion in revenue within 6 years and about 40% on a margin basis. And Rocket Lab, which has positioned itself as an alternative to SpaceX, got a big NASA contract. This for a sort of solar sail project, supposed to be a little bit more of a renewable way to get things to the edge of space. Those shares up 8%. Flip up the board, Jack Dorsey in the news, or at least his 2 companies here. Square shares moving a little bit higher here on an initiation over at Jefferies here. The shares up about 3% here. The analysts over there basically calling the leader in the, quote, neobank space, and basically saying it's a must-own. Twitter shares also higher. The company's selling off its MoPub app business. What's that?
The what bank space?
Neobank, Tom.
The neobank.
Yeah, you can go to a regular bank like you do, or you can do neobanks, which are Square, FinTech, whatever you want to call it, DeFi. I mean, they're all kind of catchwords on this space now. But basically, look, Tom, you can log on to Square, you can send me money, you can buy your crypto, you can do a lot of other things.
Square going to give me a toaster at Christmas?
I don't think they do toasters anymore, Tom. Thank you. Sorry. But anyway, you can buy the shares and maybe buy your own toaster. Twitter higher as well. AppLove and Twitter sharing off its mobile ad platform, third-party ad platform, I should say, to AppLove. And AppLove and shares about up 11% on the day, Tom.
Romain Bostic, the close here into the jobs report tomorrow. Look for that this afternoon. Right now, Sarah House helps us with the jobs report. Wells Fargo Securities, and of course, all of this back to the tradition of the great John Sylvia. They go deeper. Sarah House, you and your team have looked at this pandemic, our labor dynamics, and women. How are women doing within the pandemic and within the jobs reports we see tomorrow?
So women are still lagging behind in terms of the labor market recovery. So particularly when it comes to mothers, just given the childcare considerations that women and parents generally have had to contend with, but we've seen it disproportionately on women. So for example, the labor force participation rate of mothers has declined about 5 times the amount as we've seen for men. So I think as we head into the fall, though, we have seen some of those burdens and begin to ease. And so I think when we look ahead, we are expecting to see some improvements in the labor supply. I think there's been a lot of hype around September and just the calendar turning there between schools being back and the unemployment insurance benefits ending in all states. And I think you'll see some incremental improvement, but these are dynamics and issues that are going to take months to play out.
Let's go back to your work at London School of Economics on development. Let's look at national development. Within 3.5 trillion, whatever the number is going to be, of social programs forward, is some form of U.S. European-like childcare the most productive way to get more women employed?
I think it could certainly help. So we've seen labor force participation among women in the U.S. We used to lead the pack back in the late 90s, early 2000s, and we've just continued to follow behind. And it's because we haven't made a lot of those investments in childcare. So if you look at the labor force participation rate among women with children under the age of 6, it's about 10 percentage points lower than school-age children, which I think really speaks to the importance of a more robust childcare system in allowing women and basically a large share of your population to work and contribute to the overall economy.
In the meantime, Sarah, we've seen that participation rate just broadly continue to remain far below where it was pre-pandemic. How do you look at this rate to determine the tightness of the labor market, considering that some of these people may never come back to the labor market?
Well, I think it's still a big question in terms of what extent workers do come back. So I think some of the issues that are keeping workers on the sideline are more temporary in nature. I think, some of the childcare issues related to at least those parents of school-age children where they were having to guide their children through remote learning, perhaps not fully sure how consistently they'll be back in the classroom this fall. But I think there's questions over, okay, to what extent is this permanent? We've seen substantial retirements. If you look at labor force participation across age, you recovered about half its loss for prime age workers, but it hasn't gone anywhere for your older workers, so those 65 or older. And so I think we've seen some permanent loss of labor supply, although I still think there's still a decent amount of latent supply on the sidelines that can come into the labor market over the next year.
John, this is one of the most confusing aspects to me out there, the idea that we don't have a sense of how many people are going to return, how many people have retired, who has found a new job, what these frictions are. I mean, some of the mysteries underpinning the labor market.
How much slack is there? How tight is this labor market? How loose is it? I've got no idea. Let's make it very simple, Sarah. Big question for this market into tomorrow. How low is the bar for the Fed to execute in early November? How low is it?
I think Powell set the bar fairly low. So in his press conference coming out of the last FOMC meeting, he said they only need to see a reasonably good report. It does not need to be a knockout. So what could be reasonably good? I think probably anywhere around 350 or higher would tick that box. So that's still well above even the best year that we saw over the last cycle, where the run rate in that best year was about 260,000. And so I think given that you have seen directionally some improvement when it comes to the health situation, again, some of these supply constraints easing, I think we should see the payroll report tomorrow clear that bar.
Sarah, thank you. Sarah House there of Wells Fargo Securities weighing in on the labor market report and what it means for this Fed. Thank you, Jamie, my producer, quickly sending me across a note from Evercore. This is their call. We think the hurdle that Friday's September employment report has to clear in order for the Fed to move ahead with tapering in November, which we always said was low, is even lower than we previously addressed. What does that mean for markets? A low bar for tapering means that equities are likely to be particularly sensitive to the employment report, a good number of payroll gains that confirms solid underlying economic momentum and gives a clear go-ahead for tapering ought to be risk-on regardless of the taper
What's the
consequences.
statistics they give? They give you a number?
They said, we now believe the Fed will go ahead and taper in November, even if the report is in the ballpark of the previous disappointing report in August. Tom, that number showed a 235,000 increase.
Yeah, that's important.
So something in and around 235 still gets it done in the mind of Evercore.
Okay. I was going to take off tomorrow, but I guess I'll come in. It sounds exciting.
Well, what was this long weekend you were planning to have?
I don't know.
Okay, so you're with us for payrolls, correct?
Yeah, I'm with you for payrolls, and I got to talk to my staff about Monday.
Okay. Lisa, you happy about that? I'm happy about that, given the way things have gone this morning.
Look, I'm not going to weigh in on that. I'll let Dr. Phil deal with that. I do want to, though, talk about the threshold to cross and your question about the stock reaction. Isn't it priced in? I mean, doesn't the market broadly expect November to be the beginning of tapering? If the bar is low, doesn't that just mean that it's less indicative of potential tightening down the road?
I can't wait for your debate tomorrow that you're going to have with the guests. Going into that payrolls report. I'm with you. I'm with you.
Look, I personally think this is such a difficult moment to address because you can't really make assumptions based on such narrow frames of reference. I keep going back to this Nick Colas quote that basically that these wage increases have to be persistent across years before you get that inflationary wage spike. Well, what do you do with that if you're in the market having to trade on a daily basis?
The payrolls report 24 hours and 50 minutes away. Equities up by 1 percentage point. We advanced by 42. A fascinating note from Citigroup this morning, Tom.
Yeah, Robert Buckland.
Really heartfelt and just wonderful what Rob Buckland over at Citi is doing. Just honouring Tobias Levkovich. And Tom, I'll let their words speak for us. We mourn the passing of our dear colleague and offer deepest sympathies to his beloved family. In Tobias's honour, we renamed his flagship US panic euphoria indicator as the Levkovich Index. We were all privileged to know Tobias, and we will miss him enormously. And Tom, I know I can speak for all of us and the whole of the team. We will too.
With the First Word News, I'm Ritika Gupta. The Senate is closing in on a deal that would avert a potentially devastating default by the U.S. For now, Democrats appear to be on the verge of accepting a proposal by Senate Republican leader Mitch McConnell to push the debt limit into December. Then, Congress would have to vote again to avoid a default. Bloomberg's learned the Biden administration is debating the fate of IMF Managing Director Kristalina Georgieva. She's been caught up in an ethics scandal from the time that she was at the World Bank. The U.S. is the IMF's largest shareholder and could ask Georgieva to resign. The fund is reviewing an investigation conducted by a law firm. Bloomberg's learned that the European Central Bank is studying a new bond buying program. It would be used to prevent market turmoil when emergency purchases get phased out next year. The plan would replace the existing crisis tool and complement an older quantitative easing scheme. BNP Paribas wants to reward investors after the end of a cap on dividends. Bloomberg's learned that the French bank is exploring a number of scenarios, including raising its payout to 60% of annual profit next year. That's up from 50% this year. The FIFA soccer video games have sold hundreds of millions of copies worldwide over 2 decades. They may cease to exist in their current form after publisher Electronic Arts says it may rename them. The EAA is exploring its naming rights agreement with FIFA, soccer's international governing body. That deal is separate from EA's other official partnerships and licenses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What have we learned from this evergreen crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we see many events, right? Maybe in the fintech sector and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the evergreen is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really about whether investors are trying to get the next days or quarter right, or whether they're trying to get the next multiple years right. And so again, I hate to repeat it, but the big question is this a moment in time? Are we moving to a new higher structural inflation rate, a new higher structural level of growth?
Brian Levitt there of Invesco. Joining us yesterday, I can tell you right now, we're heading to a high level on this equity market, advancing, rallying 42, up by about 1% on the S&P from New York City this morning. Good morning. Tom Keene, Lisa Bramis, and Jonathan Ferro. Here's your lift in the equity market. A lift in the bond market, a little one, up by almost a basis point on 10s. On 10s to 152.76. Euro firmer, stronger euro to 115.66, advancing there about a positive 1/10%. Outside of that, into the commodity market, it's been a persistent rally in commodities, in crude, 76.42. This morning, negative, about $1. We're down some 1.3%.
Very good, John. Thank you so much. An important interview now to summarize, and really we could spend an hour on this discussion with Nobar Afeyan of Moderna. It is Mode, M-O-D-E-R-N-A. He is co-founder and chairman and front and center worldwide with where we are with this terrific, horrific, I should say, pandemic as well. Dr. Afeyan, thank you so much for joining us. I want to go back to Harold Edgerton in MIT. You have 2 degrees from MIT. You personify the excellence of biochemistry and bioengineering. What is next for you? Harold Edgerton always moved forward in optics. How do you move forward after the 2020 you've had?
Thanks for having me, and thanks for the kind words. It's a flattering comparison to Dr. Edgerton, and perhaps when I'm done doing what I'm doing, it might be more apt than now, where I've got a long way to go. But basically, as you may know, through my company, Flagship Pioneering, we have a platform through which we're able to make innovations that might otherwise exist years from now, but bring them forward. And it's a process that we've followed for a number of years. We have a team of over 100 scientists, engineers to do this. And out of that have come multiple breakthrough platforms, Moderna being an important one, but several dozen others, which are working on some important problems in combating disease, as well as in allowing for more sustainable development in agriculture, et cetera. So a lot of problems left unsolved, and so that's what we'll keep working on.
Dr. Afeyan, you need to expand to the frontier economies of this world. It's easy to bring mode RNA to America, to Europe, et cetera. Do you have to bring the fanciness of the present vaccines to Africa, or do you have to find a different process, a different technology?
I don't think you need a different technology, and as you may be aware, we just announced today the commitment by Moderna to establish the first ever mRNA manufacturing plant of drug substance, as well as the full finished product. We will select the location in the continent of Africa over the coming months through discussions that are ongoing. But we announced today that we plan to have production capacity of up to 500 million doses of our vaccines, multiple different vaccines that we have under development, as well as, of course, as needed for COVID. And that will involve an investment of up to $500 million is what we're sourcing right now. So that's one approach. But I should say the technology, the word fancy, of course, could also mean so sophisticated so as to be pretty simple. This is an information molecule. Everything else that's been used for vaccines before have been dramatically more complex than this. This is a pure information molecule, and if you get it safely administered, our cells know what to do with it, and they make the antigen that's needed to cause the immune system to attack any kind of threat, including the respiratory viruses that we're going after. So I think the technology actually lends itself to deployment globally.
Dr. Afeyan, I'm looking at your shares. Moderna shares up more than 890% since the end of March last year. There's been a huge surge of money into the pharmaceutical industry on the heels of the mRNA advancements, and also because there does seem to suddenly be more money for vaccines. How much is this going to be consistent, that more money will continually be deployed to vaccine development at a time when traditionally this has really seen a dearth of investment?
Well, you're making a good observation in that remarkably the most effective pharmaceutical company, which is actually our own immune system that we carry around with us every single day. It's saved more lives, it's fought back more viruses, and it's within us. And yet, historically, we've had no real access to being able to use it on our behalf. And so occasionally, people have developed vaccines over decades of work, and that's why it's been the backwaters of the pharma industry. I'm very pleased to see that people have seen a proof of concept of what vaccines can do. They're innately powerful if you know how to control them. And so I think that money is not just kind of following a short-term opportunity, but recognizes a real shift in what's possible and how effective our immune system can be. I should also say, though, that another phenomenon is driving I think the capital. That has to do with a shift in this industry from being a rather probabilistic shots on goal, we call it in the industry, kind of almost lottery where you bet on a lot of different drugs and maybe one or two out of 50 make it, versus a gradually more deterministic activity. By that, I don't mean that everything we do will work, but that we should expect many things, if not most, to work. It's just a question of iterating and learning and making better and better products. That has not been the investment thesis of the pharmaceutical industry. And so I think we're beginning stages of where this begins to look more like tech and less like this complicated speculative activity that biotech has been for the 35 years I've been in it.
Interesting. Mr. Afeyan, it's great to catch up. Let's continue this conversation another time. Moderna's Noubar Afeyan there, weighing in on how much that industry is set to change. Tom, we thought the world would change radically 11 months ago when we had that efficacy data in and around November. It was set to open the road, open the way to ease some of these supply chain issues. The world would reopen. And Tom, it's not quite happened that way, has it?
No, it hasn't. And what I would say, John, is my amateur study of a lot of pandemics, frankly, going back, hundreds and hundreds of years, they always take longer to end. That's a great common theme. And there's a rationalization, to use a baseball metaphor, somewhere in shortstop, around third base, whatever, John. In football, the last, 70 minutes on, it just goes on forever.
Sometimes in markets, though, Thomas, you don't necessarily need things to get better. You just need them to stop getting worse.
Is that where we are right now? I think so.
Up
I think
1% on the S&P. From New York City this morning, on radio, on TV. This is Bloomberg.
I'm Danny Kleppinger with an exclusive BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. 2 American stars were the headline makers on day 1 at Indian Wells. Former U.S. Open champion Sloane Stephens was pushed all the way by Britain's Heather Watson before punching her ticket into the second round. After a slow start, the 2017 winner in New York had to fight back from a set down before eventually getting across the finish line in just under 3 hours on Stadium 1. Up next for her, a first career meeting with compatriot Jessie Pegula. Later, Madison Keys blasted Kaya Kanepi off the court in the opening set that lasted just 15 minutes. And despite a more competitive second set, the former finalist at Flushing Meadows moved on to set up a meeting with Anastasia Pavlyuchenkova in round 2. And don't forget, Tennis Channel's daily live coverage from the California desert hits the air at 1 p.m. Eastern. I'm Danny Kleppinger.
As Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
The August jobs report packed a big downside punch.
That is a really, really dismal number.
Will September bring enough good news for the Fed to start a taper?
If progress continues broadly as expected, a moderation in the pace of asset purchases may soon be warranted.
Will unemployment keep going down? And what's happening with wage inflation?
It might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
Tune in for the September jobs report, Friday on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. and it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
We don't expect a rate hike until late 2022. So tapering is not tightening.
It's going to be very wobbly because there is elements here that we're dealing with stagflation.
Yes, inflation is going to become more problematic, but not problematic enough for stocks.
If inflation risks persist, you're going to see room for break-evens to continue to rise from here on.
We're trying slowly to return towards that fairy tale that we had before.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Claims here. We do that in 30 minutes. On to the jobs report tomorrow. We do it with a better market. John, I'm sorry. It's a draw up.
It's a lift, Tom, at 41, advancing 0.9%. We're trading on verbal intervention. We're not trading on resolutions.
Oh, very nice.
That's really important.
Very nice.
To draw a distinction between what's happening here. We're kicking the can in D.C. That's what it looks like. That's not a resolution. We don't resolve anything. What are we doing in the energy market? Bit of verbal intervention. What are we resolving? Right now, Tom, I don't see any resolutions there either. So sentiment's better, yes, but there's a lot still to address.
I would say this is really important, John. We've had the correction, which was a non-correction, down whatever number you want to use, 6, 7, 8%. Yes, the NASDAQ worse. John, the backstory is there's still a wall of money out there looking for a warm spot.
Do we need things to get better or stop getting worse? This from Guy Labar this morning from Jenny Montgomery Scott. The shipping bottleneck problems are officially going mainstream as usual. That probably means the worst is behind, even if the problem will take some time to resolve.
Tea leaf for the morning, John. Liz Ann Saunders does it out on Twitter with her and her team's great set of charts. Lisa Abramowitz, Liz Ann knows finally Shanghai to LA cargo rolls over. It's ever so slightly, but at least finally there's a release there on the expense of this supply bottleneck.
Can we stop worrying about stagflation now? I think that's what this comes down to, since that was the prevalent concern over the past few weeks. I do find this really interesting from a Morgan Stanley team over in Asia, the fact that basically higher oil prices isn't necessarily negative if it comes with strong demand. The question is, how persistent is that? And to the point of verbal intervention, how much are policymakers willing to adjust communication and even policy to address the smallest hiccup in markets? And that, I think, is a presiding question as we head toward tapering.
And, John, we got to revisit this. Lisa nails it here. Is the structure of our economy, service sector, goods sector, our impact on economies in America, in Europe as well, is it the same as the fear memories that we have? Carl Weinberg says this is not 1970.
We haven't had the full service sector recovery that people expected, anticipated.
Correct.
That was set to really kick higher in September, Tom. We've talked about this through the last several months now. September, at the start of September, we knew September wasn't happening. Is it October? No. November? No. December? Q1, Q2? The fact of the matter is, the bottom line, at the start of 2021, this year, we thought we'd have a lot of this dealt with. Now we're staring down the reality, perhaps, that it's 22, 23, and it stays with us a whole lot longer.
These are the headlines, John, we've got coming out right now. Let's digress to this before the data check. And Daniel Morris, Rachel, thanks for this. Democrats not seeking debt limit increase to February. I don't even understand what that headline means, which speaks volumes about Washington.
That's the moment we're in, Tom. They're looking to kick the can down the road, to delay the inevitable conversation they've got to have without resolving anything. I'll see you at the end of November, December time. That seems to be the direction of travel down in Washington, D.C.
The direction of travel this morning is I'm going to go, John, to the big round number. NASDAQ bouncing off the negative 11% you talked about, up 1.2% today, NASDAQ 100.
It's just a really nice lift out there, Tom. The bond market not doing much. Yields unchanged on 10s right now, 152.24. Crude, the turn in energy. It just seems right now there is an inverse correlation between risk assets and energy, apparently. Crude is down by 1.5% to 76.30. We're down a little more than $1, Tom, with the equity market up big, up 0.9%.
Let us synthesize right now. We're going to get to it here with Daniel Morris of BNP Paribas. Thrilled he could join us today on the strategy of the moment. Let me go to the marginal strategy, the marginal thought, Daniel Morris. What have you changed in your belief construct in the last 10 tumultuous days?
I mean, I think the surprise perhaps has been primarily about the performance in Europe versus the U.S. So on one hand, if you go back to the Fed meeting, if you had asked me before the Fed meeting, let's say it comes out to be a hawkish surprise, Fed funds futures rise, real rates rise, what happens to the market? I would say NASDAQ sells off, and that's more or less what's occurred. I would have also said, however, that Europe should outperform because that growth exposure in the U.S. is going to drag down U.S. relative to the performance in Europe. But in fact, what we've had is Europe continuing to underperform. So I think what we've seen over the last couple of weeks is what seems to be a bigger impact on Europe in terms of the increase in prices, supply chain bottlenecks, exposure to China that are dragging down European equities across most sectors in a way that it's not hitting the U.S. despite the bigger increase in real rates.
Oh, excuse me, John, please.
Well, you've got a follow-up, Tom. What is it?
No, I don't have a follow-up.
Well, I just wanted Dan to sit on the European distinction. I think it's an important one.
Okay, please.
People have really increased their exposure there, Dan. I'm trying to understand from your perspective there where they should reduce it. Where specifically?
Well, our current allocation is underweight European large cap versus US anyway. Our overweights in Europe are to European small cap. So we do see the potential there primarily in the recovery story that, as you pointed out, we thought would start in September and hopefully will come up towards the end of the year instead. But in terms of the exposures that you see in Europe, I think it really is going to be a function of the flexibility of the labor markets, right? It's always something that we talk about with these bottlenecks, both on the production side and on the labor market side, having to adjust to these unprecedented events. On one hand, companies can be criticized for not having planned better. Why don't we have enough parts stocked for whatever they need to produce? But of course, we've gone through a period that no one had been through before. I think it's understandable that companies didn't always react in the right way. But the key point now is who's going to have that flexibility to be able to adapt more quickly, and they're the ones that you're going to see outperform.
And a lot of people have looked to the United States in terms of the flexibility of shrinking this labor market friction that we see ongoing. Tomorrow with the jobs report, people are expecting it, with Ellen Zentner over at Morgan Stanley, expecting a higher than average estimate going into that print. Is the market pricing in a November taper for the Federal Reserve?
I think so. The Fed's been pretty clear in its communication. The last thing it wants to do is to surprise the market, and really it should be priced in. You'd have to have a pretty catastrophic payrolls figure, I think, for the Fed to change the timeline that it's laid out, that it is announced in November, starts in December, and should finish by the summer. I think it's at some point, probably until the first quarter, we're going to start thinking much more about hikes in policy rates, and that'll be the thing that drives the markets, particularly the dollar. But for now, I'd almost argue that tapering is a non-issue. And the key thing we need to focus on is how earnings come in relative to expectations, particularly remembering the enormously high bar we had from the first and second quarters when surprises were just so far beyond expectation.
Daniel Morris, Citigroup comes out with sort of a global strategy summation into the end of the year. They honored Tobias Levkovich, and the underpin to that is a yield move to 2%. BNP Paribas has been so darn good about framing yield against the economy. Do you ascribe as well to a 2% yield out there?
I don't know if I'm going to put a number on it, but I will go as far as say we do think yields are going to continue to go up. We have underweights on duration, underweights on real yields in our multi-asset portfolio and in our rates portfolio, so it is an anticipation that they'll go higher. I don't know that we need to have a specific number yet. I think it's always evolving, looking at particularly what's happening on the inflation front. And a key driver of that, and this is something also that arguably has changed over the last couple of weeks, what's happening with medium to long-term inflation expectations. The story from the Fed for a long time now has been all these inflationary pressures are temporary, and you saw that in the market. 1 year, 2 year inflation expectations shot up a lot, but 5 year, 10 year really didn't move at all. So we're starting to see a little bit more movement there. And if you did see that rising, the phrase that it becomes unanchored, expectations starting to get baked into the market about more persistent inflation. That's probably the biggest risk to the market right now.
If that is true and yields do continue to climb, are stocks in the United States cheap or expensive right now?
Very well framed, because it's that level of interest rates that is the key factor in determining whether stocks are cheap or expensive. We're so used to looking at PEs and saying, a while ago the PE for NASDAQ was at 30 times, or the PE for the S&P, 22 versus a long run average of 15, and you conclude that stocks are just wildly expensive. However, I think that's not a relevant analysis now because of QE and because of the suppression of interest rates you've had because of QE. So our view is more that stocks arguably can sustain these high multiples because of quantitative easing, and until that reverses, and we don't think that's going to happen anytime soon, we're probably less concerned about the risk on the valuation front and paying a lot more attention to the earnings front.
Dan, thank you, sir. As always, good to catch up with you out of London. Dan Morris there of BNP Paribas. Sometimes you've got to make it really simple. This is the March Towards Payrolls Friday. That happens tomorrow. Jobless claims happen in about 20 minutes' time. Tomorrow, the median estimate is 500K. A simple question a lot of people will be asking. What number do we need for the Fed to execute tapering on November 3rd? Yeah. This is the quote that stands out from Chairman Powell. He essentially tried to answer that question in the last news conference when he said the following, quote, "It wouldn't take a knockout great super strong employment report. It would take a reasonably good report for me to feel like that test is met." Now, Tom, this is where things start to get a bit silly. From simple to silly. Yeah. We have to define what a reasonably good employment report actually is for Chairman Powell.
Is our next phrase substantial further taper?
You'd have to believe, Tom, it was something in line with 235, which is the point Evercore are trying to make this morning.
We have drifted so far from some kind of fundamental theory on our economics as well, John. John, I look at this and what we heard from Daniel Morris, and off the bottom of 1.12% in the 10-year yield, so we moved to 1.55%. I don't think it's linear. I think the move from 155 up to something higher, and I don't know what that's going to be, is ginormous ramifications.
The moves we're seeing, Tom, the move from the start of the year, from about 90-odd basis points to 170, that move is very different to what we're experiencing now, 112.58 from the lows of August out to who knows where. The conversation's changed.
Where's the conversation at a 180, a 190, or Citigroup's too?
Well, earlier this year, we had accelerating growth expectations to complement that.
Yes.
The Federal Reserve was comfortable with it. Will they be comfortable with it this time around, given what's happening to growth expectations into next year? That's a question.
Well, and what does Q4 look like, particularly after we get through the earnings calls and their visibility? I think that's next week if I'm here.
October 13th, you're going to be here?
I think I'll be here.
I hope you're here, Tom. Not sure what's going on in there, but I hope you're here. JP Morgan kicked things off. October 13th.
Late, John.
Tom Keane.
The games are on awful
Lisa
late.
Bramage, Jonathan Ferro. Tom, staying up tonight for some baseball. That means he'll really be on form tomorrow morning.
Thank you.
Equity futures up 0.9 to 1% on the S&P.
Oh, you think it's funny, Lisa?
This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Democrats are signaling they'll accept Senate Republican leader Mitch McConnell's offer to raise the debt ceiling into December. That would avert the immediate risk of a default, but it also increases the risk of another political fight near the end of the year. A federal judge has temporarily blocked Texas' new ban on most abortions. He said the law outsourcing enforcement to bounty hunting members of the public was contrived to get around a constitutional right. It's a major win for the Biden administration, which has sued to overturn the ban. And Apple has a new plan for cars. Bloomberg's learned it's working on technology that would allow drivers to use iPhones to control the air conditioning, seats, and radio, amongst other functions. Apple's CarPlay interface is already used by millions of motorists to control music, get directions, and make phone calls. CarPlay is offered by most major automakers. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We have to build our capacity to be less dependent. And I think everybody now can completely identify the fact that when we speak about sovereignty, it means exactly that. Being sovereign means being less dependent on the others, and it's critical for us.
That is true, and it has been true for a long, long time in Europe when it comes to energy. President of France, Emmanuel Macron, from New York City this morning. Good morning. Tom Keane, Lisa Bravitz and Jonathan Ferro. Your price action shaping up as follows in the equity market. Futures positive 40 on the S&P. We advanced by 0.9%. A monster reversal yesterday, the biggest one-day reversal going back to February. We add some weight to the rally, up by 40 this morning. Yields up about a half a basis point to 152.59. That inverse correlation between risk assets and energy seems to be biting again. Equities up, crude lower, coming off 7-year highs. We're down 1.5% on WTI, Tom, $76.29.
Oh, $76.29. John likes WTI. I go to the Brent price, 80.17, about $2 underneath where we are. She is absolutely exquisite at the microeconomics, the microdynamics, the price theory of hydrocarbons. Amrita Sen joins us from Energy Aspects. We tried for 3 days, I think, to get her on the show. We're thrilled she could join us this morning. Amrita, when you look at the Marshallian cross of demand and supply, what's the single thing our listeners, our viewers need to know? What's the dynamics of oil price and supply demand right now?
Well, you flatter me, Tom, firstly, but I'll say this much, that, look, inventories around the world are extremely low.
everywhere. And that is ultimately the reason, because supply just isn't keeping up with demand. Yes, OPEC has spare capacity, but it is choosing to bring back production slowly because there are a lot of uncertainties going into the Northern Hemisphere winter. We don't know whether there's going to be COVID flare-ups. So fair enough, they're being cautious, but inventories everywhere, crude particularly, but even products very, very low.
When you look at inventory dynamics and your guesstimates, your forecasts, how far out does a pro like you look, given what you just said? Are you trying to guess out a week or a month, a quarter? What's the length of the guess right now, given these growing demand?
Well, we do it all the way through to the end of next year. So we try and at least have a 12 to 18-month period for the short-term outlook. But of course, it does become less and less certain the further out you go. For the next 3 months, we can be a lot more certain, given all the kind of high-frequency data that we are looking at.
Amrita, we had two pieces of verbal intervention yesterday, one from the Russian president and another from the energy secretary here in the United States, Secretary Granholm. Out of those two, which one or both are actually credible statements?
What if I say neither? But honestly, I think, jokes apart, the reality is what we've seen from the White House in particular is that they're not talking about an SPR release as an imminent policy tool. This was a question asked, and the answer was that, yes, of course, all options are on the table. OPEC says that to us all the time. All options are on the table. The key to remember is that the Biden administration is very, very keen to have low gasoline prices for consumers. So we should always keep that in mind. And if prices continue to go up and overheat, then yes, they will be putting more pressure on OPEC, and yes, then SPR can become a tool. With regards to gas and what Putin said, the reality is that Russian gas inventories are low. Even if they wanted to increase exports, they have to refill inventories themselves, and that's why European gas prices are so high. Again, stocks are very, very low in Europe.
So frame winter for me, Amrita. I'm trying to understand how tethered the oil story is to what happens with gas, given we're having a bigger conversation about substitution now. What does that look like for you through a cold winter in Europe?
I think if it's a cold winter, we just have to be prepared for very, very high gas and oil prices. To your point, I mean, yes, there's substitution. In Europe, it's actually very small because there are a lot of environmental restrictions. The place to look out for will be actually in the US, and particularly on the East Coast. You can get more heating oil burn. Even in Asia, Japan can burn more fuel oil. So that will, again, push up prices. So gas and oil kind of pull each other up. But ultimately, this is a fallout of energy transition. The policies of Western policymakers where you've retired coal-fired plants before demand has come off. So we are going to be in this era of kind of high fossil fuel or high energy prices till demand for fossil fuel comes off. And that's still years away.
Well, Amrita, that's exactly where I wanted to go. What is the correct broader narrative to view the recent increases in oil prices? Is it what you were just talking about, the idea of the fallout from the mismatches here in energy policy and a stagflationary-like type trend? Or is it recovery, the fact that demand is increasing at a time that seems to be faster than supplies can come back online?
I mean, of course, it's a combination of both. And the latter point that you're making, I mean, you can't ignore that. Yes, there's a lot of pent-up demand after COVID. And if anything, in a way, COVID's kind of brought more demand to the market because people just want to go get on and whether it be driving or flying. But the underlying narrative is absolutely about energy transition and the choices policymakers will have to make, because these are very stark choices that potentially need to be made as soon as this winter. Are you going to have rolling blackouts? Are you going to sacrifice economic growth? And this is something, we have been talking about for a while. There is no investment in oil. That's why this is a structural move higher in oil prices. This is a structural move higher in gas prices. Not saying gas will stay here. It will come off, but it will still remain much higher than it has been for the last 10 years.
Amrita, thank you for weighing in. And great to catch up as always. Stay close. Amrita Sen there of Energy Aspects on this energy rally in Europe, which has just been phenomenal, Tom. We need to frame the climate change conference that takes place, had by the UN at the end of the month, Tom.
I agree.
There's going to be a very uncomfortable conversation if these gas prices are still where they are.
Yep. I've been thinking about it, John. You are dead on in this. I was researching 2 days ago an energy conference in Japan, I believe sponsored by Platts, our good friends at Platts. And John, what they said in Japan, they're going to say at the energy conference coming up. Guess what? If you want climate change, that changed the price theory of what Amrita sends studies every day.
Increasingly, the electorate has been on side with this transition in a big way,
Yes.
Lisa.
Yeah.
What that has led to is disincentivizing investment in these spaces. It has taken capacity out in places like coal, in China, and now we're starting to see prices surge ever higher. I stress that the electorate's been on board with this transition in a big way across most of Europe, Lisa, but when prices start to rocket, that's going to be quite comfortable. You can see where the tension is as they meet at the end of this month into November.
There needs to be a really honest discussion about what is feasible in terms of bringing up the greener energy sources in time to rectify some of these mismatches, right? I mean, the idea of if you can't, then what's the next best or least worst fossil fuel to use? There has to be a reality check in this transition process as we end up with much higher prices on a structural level.
COP26 taking place in Glasgow this year at the end of October into the middle of November. On the energy story in Europe, a brutal change in the past 24 hours. Road trip, is that what you're about to say?
John, October is beautiful in Glasgow, and what we could see there, they have one of the greatest collection of James McNeill Whistler's
I can introduce you, Tom, to a deep-fried Mars bar in Glasgow.
Oh, what? Really?
Would you like that?
I can introduce that to you in
You get a
at the State Fair
battered Mars bar
in Wisconsin.
Would you like
Do they
that?
have a football team? Do they have
Glasgow Rangers, Tom?
Yeah.
Yeah. I'll get you up to speed. Road trip.
It says road trip. I'm sorry.
You watch though, Lisa. The funny thing about this is, by Monday, Tom Keane will know more about Scotland than I will.
1,000%.
Without a doubt.
Without a
From
doubt.
New York City, this is Bloomberg.
Extremely thankful. They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while.
They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City for our audience worldwide, heard on radio, seen on TV. This is Bloomberg Surveillance, your economic data seconds away. Equity futures going into that, up 0.9% on the S&P. We advanced 40 points. Your 10-year yield up a basis point to 153.46. With some economic data, here's Mike McKee.
All right, John, let's take a look at the numbers here. We come in at 326,000, which is a decline from the 362,000, the first time we've fallen in 4 weeks. The forecast was for 348,000. So some good news from the claims numbers ahead of the jobs report for the month. And we will look for any kind of change we might see in the forecasts for the payrolls tomorrow. We did see a change overnight as the ADP numbers got incorporated into the release. We're now looking at 500,000 jobs created instead of 488. Maybe this will be a reason for some optimism.
Mike, as we like to say, it is the right kind of downside surprise on claims. Yields higher by a basis point or two, basically where we were going into this. We're a little bit higher at 153.63. Equities are firmer, up by 0.9% on the S&P. We advanced by about 39 points. And Mike, it's on to payrolls Friday, 500K, the estimate.
Yeah, whether we get 500,000 or not, something in that range is going to be probably good enough for the Fed. They're looking for an improvement over the 235,000 we got in the month of August. One of the biggest changes, of course, is the drop in the number of total people getting jobless benefits, and that's now fallen in the week that followed the jobless week to 4,172,000. And remember, it was 24 million a year ago, so we've really fallen off as those jobless benefits were cut. Maybe that forced people back into the labor market.
Mike, I want to go back to first principles for our listeners and viewers. What is the linkage of what I call an asymmetric study, like claims, it shows one side of the jobs market, to the two reports we see tomorrow? How does a pro like you dovetail them together?
Well, you kind of look at the trend. You don't look at any kind of direct correlation, although the movement in direction is reasonably well correlated. As jobless claims go down, usually hiring goes up. It's hard to make a case, though, in this situation because we've not been in this situation. We have 326,000 initial jobless claims, which we're celebrating as good news, and yet that's higher than in any week between 2015 and the COVID when COVID hit in March of 2020. So we still have a lot of people who are out of work.
Mike, thank you. As always, jobless claims. That's the right kind of number, Tom. We want that lower, but we're getting there. 326 against an estimate of 348.
I haven't looked at the data from today, but it is one of the most elegant charts I've got in the quiver, John. It's actually got a very nice trend to it, even though we're impatient to get that trend much improved. We are impatient to speak with David Page of AXA. He folds in York and Warwick economics. He's got some government service with the United Kingdom, and we're thrilled that Mr. Page could join us this morning. David Page, I'm going to give you an Econ 101 question. Is the glass...
Speaking, we are still seeing a relatively strong rebound. You know, it'll feed through into jobs. We are expecting to see a decent number coming through there, and it should continue well into next year.
You mentioned what I want to go to off of yesterday, I believe it was, the trade balance numbers, folks. Shockingly grim for America. This is exports minus imports with two sets of dynamics. David Page, how do you change your economic growth views forward given such export and import uncertainties?
Well, there was always going to be this pull from the US because, of course, what we'd seen from the US was this domestic stimulus. So we'd seen that lift in growth. We're very much hopeful that the US closes all of its spare capacity by the end of this year. It's operating in excess demand into next year. But its recovery has come ahead of that of the rest of the world. So when you've got effectively a domestic fueled growth coming through, you're always going to be sucking in a large amount of imports. Now, the rest of the world is recovering as well. We are seeing a pickup in demand, but not quick enough to see the US's exports to the rest of the world offset that. So there was always likely to be this sort of net trade drag, and I think that's going to continue through next year. It should soften a little bit next year because we're expecting the rest of the world, and particularly, for example, Europe, to follow through. But there was always going to be this net trade drag, and that's what we're seeing coming through at the moment.
David, as we prepare for tomorrow for the labor market report, there is the ongoing conundrum, are we in a tight or a loose labor market? What are you looking for from these numbers, from the numbers that we see in November, in December, to determine the answer to that question?
Participation rate. I mean, if you look at a chart, the thing that really stands out is that with all the recovery that we're seeing coming through, we're now, 3/4 of the way recovered in the total jobs lost since 2019 at the since early 2020 at the worst. But the participation rate has leveled off around 61.8%. And there's been all sorts of explanations, unemployment benefits or healthcare or childcare even. So a number of issues, but the fact of the matter is that there are just not that many people coming back into the labour market. And that's why you're getting this weird sort of dichotomy. There's still lots of people, or a lot lower level of employment than there was pre-COVID, but there's this massive pickup in vacancies and high jobs turnover coming through. So it's really getting people back into the labour force. Now, it's probably too optimistic to see a material change come through in this month's numbers tomorrow, but we will be hoping to see some effect of that coming through, partially from the unemployment benefits, but I think much more so from the pickup in childcare facilities. We've already seen sort of nursery spend starting to pick up a little bit on that. That's hopefully going to help people come back into the market there. So all of those issues should start to manifest over the next couple of months. But it's that trend that's going to be key, because fundamentally, if we don't see the labour force rise, that's the shock that's going to weigh on US output. It's going to be very difficult for the US economy to continue to power ahead if its labour force isn't stepping up. So over the next few months, that's the key, I think, to where we're looking.
That's interesting. That's a different interpretation than some people would say, who say that the labor market is tight, that these people might not be coming back into the market, and that will actually lead to more wage increases, higher wage inflation, that leads to a more sustainable inflationary outlook for the United States. Are you pushing back against that?
Yeah, I don't think it'll necessarily. I don't think what's keeping people back at the moment is low wages. I think there's been a fundamental shift that's come through from the pandemic, and it's not clear how quickly that will pass. And as I say, we've talked about a couple of the issues like concerns for childcare, but you also flashed up in that graphic the prospect of mismatches. There could fundamentally be a more structural issue here. It may well be that the people that have left the labour force don't see the opportunities to come back, and don't, for whatever reason, whether there's a skills mismatch or a geography mismatch. And so that could be a structural factor. But wages, I think, will be a byproduct of what comes through. Typically, labour force engagement improves as you go through the cycle. The stronger the economy runs, the more you tend to see people coming back into the market. But that does typically come around at the same time as wages. So coincidentally, the two come together. But I don't think that people are staying out of the labour market now because they don't think wages are high.
David, very quickly here, X is an insurance company. You have huge, medium, and very long-term liabilities as well. After the uproar of the last number of years, and particularly the global fiscal expansion, are we back to a single-digit world? Are we back to where insurance companies in serious money have to reduce down their actuarial assumption forward?
In terms of life expectancy, or
investment return.
Oh, well, I think what we're likely to see is a period where it's going to be a little bit tougher. And I think for the person on the street, that's going to be an interesting one to talk to, because we've gone through a period where economically it's been very bleak over the last year or so, and yet investment returns have been very good. But yeah, I think as we move a little bit further ahead, I think that the headwinds are going to be there, and part of that is monetary policy. Part of what we've seen is global central banks deliberately providing a boost, which has fallen through into asset prices and has helped investment returns. And I think as that process normalizes, and we look forward to some central banks actually reversing that, then that's obviously going to be a headwind to all risk assets. So it's not just that we're going to be starting to see longer-term yields rise, but it'll also be a headwind to risk assets as well.
David, thank you. David Page there of AXA Investment joining us on the latest in this economy. Tom, I made a bit of an error a little bit earlier. I talked about Glasgow Rangers without talking about Celtic. Without getting involved in that particular rivalry, there is another club there too, Tom. It's called Celtic. Okay, you do some research on that and work that one out too. Coming up a little bit later at the top of the hour, 9 a.m. Eastern time, Chris Harvey of Wells Fargo Securities, the head of equity strategy. Tom,
yeah.
Chris, super bullish. Looking for a move through 4,800.
Let's go against that. Damian Sassower just publishing for Bloomberg, John. Sassower, the fierce headwinds. He sees the sea of negativity. The sea of negativity.
Was that written, Dear Lisa?
100%.
Was that what that is?
Have
we read the note yet? Because I haven't got the note.
No, we don't read the notes. We just do the
going through the headlines. I'll go through the headlines of this equity market for you.
Don't let radio and TV know, John.
Up 41 on the S&P.
Read the note.
No one's listening, Tom. We're at 1%. We advance. There's a lift in Treasury yields off the back of a better than expected jobless claims number. The right kind of downside surprise. Yields are higher by a couple of basis points to 154 on 10s. Talked about this lift in this equity market. Let's talk about this drop in this crude market. 77 off the lows, but still negative. Down 0.5%. We're down about 43 cents to $77 and about 7 cents, Tom.
We're going to get a 19 print on the VIX. We're not there yet, but come on.
Back.
It's morning in America.
What do you call it, Tom? The draw up?
It's a draw up.
Draw
it's
down.
morning in America.
Just beautiful.
Poetry.
From New York. I'm running. This is Bloomberg.
As fast as you can.
With the First Word News, I'm Rich Gupta. The Senate is closing in on a deal that would avert a potentially devastating default by the U.S. for now. Democrats appear to be on the verge of accepting a proposal by Senate Republican leader Mitch McConnell to push the debt limit into December. Then Congress would have to vote again to avoid a default. Bloomberg's learned the Biden administration is debating the fate of IMF Managing Director Kristalina Georgieva. She's been caught up in an ethics scandal from the time she was at the World Bank. The U.S. is the IMF's largest shareholder and could ask Georgieva to resign. The fund is reviewing an investigation conducted by a law firm. Pfizer and BioNTech have asked U.S. regulators to approve emergency use of their coronavirus vaccine for children aged 5 to 11. It's a move that could affect both family life and how schools operate. The Food and Drug Administration has promised to act quickly on the request. Royal Dutch Shell says the events of a turbulent third quarter will have a significant impact on its financials. The company gave a first glimpse of what's likely to be an unpredictable set of earnings for the oil majors. There were big swings in gas and power prices. Plus, Shell says the adverse effects of Hurricane Ida in the Gulf of Mexico will end up costing $400 million. BNP Paribas wants to reward investors after the end of the big cap on dividends. Bloomberg's learned that the French bank is exploring a number of scenarios, including raising its payout to 60% of annual profit next year. That's up from 50% this year. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Anywhere around 350 or higher would tick that box. I think given that you have seen directionally some improvement when it comes to the health situation, again, some of these supply constraints easing, I think we should see the payroll reports tomorrow clear that bar.
Sarah House, Wells Fargo Economics, looking there, of course, to jobs day. We just had claims. If you're just joining us, claims I'm going to call better than good, maybe not market moving, but nevertheless, there it was. Lisa Bramwitz and Tom King to drive forward. Let's move from the economics of the moment over to the markets. A 2-hour conversation with Gina Martin Adams of Bloomberg Intelligence. We'll squeeze it in right now. Hermes out with earnings today. I mentioned it earlier, and they did something in the opening paragraph. They said, we're going to ignore 2020. We're going to do a compare and contrast back to pre-pandemic, to fiscal year, maybe even Q4 2019. Is everybody going to do that this time around?
I think a lot of companies are, because a lot of investors are doing that already. And we saw that really pop up in the very beginning of this year when comps were so extremely easy that you're looking at 50 to 90% growth on a year-over-year basis. So investors are going back and saying, okay, where's your pre-pandemic norm and how do you compare to that pre-pandemic norm? And certainly what we're finding is the vast majority of S&P 500 companies, industries, and sectors are already well above that 2019 benchmark and are now starting to talk about, well, what is our normalized revenue growth outlook? How are we going to contend with costs going forward? 2020 is largely in the past. What's our new normal, so to speak?
So I got a chart. I haven't put it out yet on TV, folks. I'm still dressing it. And it's the bull and the bear of the street on earnings to the multiple compression expected. Let's review this right now. 12 months forward for Bloomberg Intelligence. Do you believe that we will see whatever the earnings number is, let's call that stability, but within that ratio, P to E moves around? Which way will it move?
PE probably moves lower. And that's more reflecting a tighter monetary policy, as well as still persistent earnings growth. Price just trails earnings growth reality in that kind of environment. So we've got earnings growth for the S&P 500, for example, of roughly 13%. Consensus thinks it's closer to 17%. PE contracts a tiny bit, and the reality is then you get about an 8% upside for S&P 500.
Gina, this is exactly where I wanted to go. How does the equity market price in a taper, or has it already done so?
I think it starts to price when taper actually happens, and more importantly, the risky point for equities is not actually the taper, but it's when the balance sheet stops rising altogether. So taper effectively, I think we all can acknowledge, is a slower pace of asset purchases, right? The balance sheet is still rising. Maybe it's accelerating at a slower pace than it has been in the past, but it's still net liquidity increase that generally benefits risk tolerance. It's just less so than we've become accustomed to. The real risk point is actually once they stop tapering and they stop purchasing, and then beyond that, the risky point becomes when the balance sheet starts contracting. We're still quite a ways from that point. So I don't think investors have really priced a ton of movement from the Fed. Instead, they're starting to price more really earnings realities and sort of friction that's been developing with respect to stickier than expected inflation, a little bit of margin pressure emerging in the period of time in which the economy moves from really rapid recovery to expansion pace.
So we've been flip-flopping with the narratives from stagflation to Goldilocks, and we can't decide which one to go with. There is an issue, though, when you talk about downgrading some of the expectations for our earnings. Have we already reached peak supply chain disruption concern? It's catchy, I know, but are we already there?
I think we're really close. The problem that we're contending with is it's persistent. So that peak supply chain disruption concern, we would have thought that would have happened in the second quarter. It continued into the third quarter. It may continue into the fourth quarter. It's not getting worse, but it's more persistent than anyone had anticipated. And I think that's what's frankly really driving a lot of the margin expectation declines across the analyst community is, oh, okay, it's still bad. Why is it still bad? We thought it would start to ease from here going forward.
2020 hindsight, I think last quarter and the quarter before in this natural disaster, a lot of people missed the mark. Are we doing that this time around where within the earnings margin gloom, we may miss the mark and it be more optimistic than we expect?
Absolutely possible, especially if we see some easing in the energy cost pressures. I think what's happened over the course of the last 6 weeks is we've seen this remarkable surge in energy costs and supply constraints emerge. If those clear faster than expected, that could provide a tremendous amount of relief to forecasts because that input cost is very disruptive. And it's creating a lot of turmoil in hedging programs, and no one knows how to hedge for this type of environment right now, and doesn't necessarily want to under the presumption that it eases going forward. So I think that if that eases, we can have a much stronger upside. I would totally agree with you that revenue forecasts are persistently far too pessimistic, and I think that's really important consideration for a longer-term investor. One of the discussions that we just completely neglect here is that demand is much stronger over the course of the last year and a half. It's much, much stronger than anticipated. Top line growth has been much stronger than anticipated, and that very well may persist. The question, though, is how does that pair with stronger than anticipated, supply chain constraints as well?
Is this fun? I mean, within all the chaos of it all.
Existential Thursday.
I think it's fascinating.
It's fun.
It's been a wild ride for sure. It's been a lot of fun to follow the market and also the earnings stream. It's been amazing to see how rapid the recovery was in response to the most prolific policy reaction that I think any of us have ever seen and may ever see.
Okay, but on the floor of Bloomberg Intelligence, folks, you got to understand, Martin Adams put in kegs of Pabst Blue Ribbon beer to keep everybody going. Get them back in the office, right?
Yeah, it's been a wild ride for sure, but we're back at it. We're back in the office and absolutely really enjoying the trip.
Well, we're getting ready for it. October 13th, I believe, is launch here. Mr. Diamond will get on a conference call and start screaming. Gina Martin Adams of Bloomberg Intelligence, again, her iconic moment. Don't go to cash. You got to participate if you want to play the game and win. We'll have much more from her through the week and her wonderful team at Bloomberg Intelligence. Lisa, what are you looking at?
I'm watching the initial jobless claims. I'm trying to parse into them, and there's a really good point made by Peter Bufar of Leakley Advisory, where he's talking about the understanding behind these headline numbers. You have some jobs that are very hard to fill, companies that are paying up for them, and then you have others, like the auto sector in particular, that are having temporary temporary layoffs because they don't have the supplies to build the cars, why it's so difficult to parse out the noise from the signal here underneath the labor market data that is coming in better than expected. I do think that it's important to kind of understand those nuances.
Yeah, well, the labor market's coming better expected, but again, it goes back, and folks, this is separate from what we just talked to Ms. Martin Adams about. But Lisa, it goes back to the fundamental debate day to day, which is the two or the three Americas. And they're literally two separate conversations.
Yeah, and talking to that point, we've got the lowest numbers of continuing claims going back to the heart of the pandemic, March 2020. Is this a good thing for the economy? Does that mean people are employed, or is it a bad thing, meaning they've got less disposable income?
We're going to do a data check because Farrell's not going to do one on TV in the next hour. I'm sure of that. Futures up 42, Dow futures up 317. The VIX comes in. I'm looking for a 19 print. All is clear. We haven't got there yet. 20.06 on the VIX. It's a better tape today. Stay with us on radio, on television. This is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
August jobs report packed a big downside punch.
That is a really, really dismal number.
Will September bring enough good news for the Fed to start a taper?
If progress continues broadly as expected, a moderation in the pace of asset purchases may soon be warranted.
Will unemployment keep going down? And what's happening with wage inflation?
It might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
Tune in for the September jobs report, Friday on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah. Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Flipping yesterday morning upside down from New York City for our audience worldwide. Good morning, good morning. Here's the price action. Equity futures up 40, advancing 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with John. Jonathan Farrow.
From New York, we begin with the big issue. It's the calm before payrolls.
Some of the pressure has been clearly taken off regarding the debt ceiling, the McConnell offer.
Gas prices, all that stuff is temporary. It's not permanent.
We may have seen a peak in some of these cycles.
That probably calms markets.
We've been through this sort of movie many times.
There are still some topics that could weigh on the market.
Especially heading into payrolls.
Exciting data point coming out tomorrow.
The payroll reports have been coming out all over the map.
We really need to have some ease on the jobs market.
This jobs report is huge if you want to dispel that stagflation argument.
Until we have more conclusive data.
The Fed has some time here, but it's the market that's granting that time.
Joining us now to discuss is BNY Mellon's Alicia Levine, Chris Harvey of Wells Fargo, and Larry Adam of Raymond James. Let's start with you, Alicia. What kind of number are you looking for tomorrow?
So we think there's actually risk to the upside in the number, simply because with the expiration of the unemployment benefits, we're going to get it captured in this month. But in addition, if you look at the data sets, talking about use of services, travel, restaurant visits, it's actually started to tick up in the last few weeks of September. And why does that matter? Because we think it's going to open up the service sector in terms of employment. And that's where we really saw the lack of recovery for workers. So we think there's 500 is the number, but there's risk to the upside in this particular month. And that'll be good for the Fed's plans.
Chris Harvey, 500K is the number. What are you looking for, sir?
John, we're looking for a positive number. We think as long as the number isn't horrific, taper is on, and that's the most important thing. We'll give you the consensus, but as long as it's not a horrific number, we're good with taper. Taper moves forward. And again, that is the most important thing that we see. And that's the only thing that we think can hold back taper at this point in time.
That's the most important question for this market as well. Larry Adam, what number gets it done for the Fed on November 3rd?
So similarly, we're looking for 440,000 jobs to be created, the unemployment rate to go down to 5.1. And, look, unless that number comes in at around 100,000 or lower, that's more or less the more disastrous number. And I think that could cause some pause. But, we've been saying for a long time, the Fed is going to taper because the reason they were actually doing quantitative easing, whether it was to narrow spreads, increase confidence, raise asset prices, all of those things have already been accomplished, and it's not really doing any further good. So I think they should pull that tool back and put it back in their bag.
Chairman Powell was actually asked this question in the last news conference. For those of you that don't remember, this is what he had to say.
It wouldn't take a knockout, great, super strong employment report. It would take a reasonably good employment report for me to feel like that test is met.
Mike McKee, you know how this works, sir. It would take a reasonably good employment report. What is reasonably good tomorrow?
It's typical Fed speak. It's we define it as we want to, depending on how the data come out. However, I think you're going to have to see something in the 300 to 400,000 range. The signs are we will get there. ADP came in a little bit stronger than expected. The ISM employment numbers, not too bad. And today we get jobless claims adding to the positive news as they fall to 326,000. That is the lowest in 4 weeks, although it is still higher than anything since 2014, except for the pandemic months. The ongoing claims numbers, you can see the orange line there, fell significantly at the beginning of September, and they are still down just over 4 million. So more people perhaps in the labor force looking for jobs that will help out. Now, you go on from that, though, and you look at the week that they took the survey, and that's the problem here. You see that at this point, we have the jobless claims numbers were peaking at that time, as were COVID cases. And so there is some evidence weighing on the other side of it. And you can see how the forecasts have now changed. We're looking at 500,000, as you mentioned, John, from 488 yesterday. Both of those significantly better than what we saw in August. So if we get either kind of number, it probably means tapering is on.
Mike McKee, thank you, sir. This range, again, is so wide, anywhere from 750K down to 0. Ellen Zentner at Morgan Stanley this morning looking for 700K. Evercore write this on what the Fed needs. The Fed will go ahead and taper in November, even if the report is in the ballpark of the previous 235K increase. A low bar for tapering means a good number ought to be risk on regardless of the taper consequences. Chris Harvey, I sense from your position, you share that view.
So a good number, so what we have to think about, a really big number, 700 plus, that's going to push rates higher. We have had a sell-off in duration in equity markets. You have to think about the push and the pull. Higher interest rates, and if you see rates gap higher, and they could on a really, really big number, then you have to be concerned that tech will pull back. That's not our belief, but that's the fear. The underlying positive, though, is your energy, your materials, your financial stocks should pop. So we'll see a push and a pull. So it's not a really big number, isn't necessarily a big uptake. A really big number means that the reinflation trade is on, and you're going to have to mark some time in tech.
Let's talk about what trade this is. You mentioned energy. I want to talk about energy prices. The massive turnaround we've seen in the last 24 hours, not just in the equity market, but at the epicenter of this has been the energy story. Some soothing comments from the likes of Russia. Vladimir Putin, the president, saying, let's think through the potential increase of supply on the market, only we need to do it carefully. Russia is a reliable gas supplier and always fulfills all its obligations. Nat gas turned around. Meanwhile, energy, crude, turned around as well. The energy secretary here in the United States telling the FT, quote, all tools are on the table. Now, I'm trying to work out, Larry Adam, here, whether this is verbal intervention followed up by something credible or just talk. Which one is it for you, Larry?
I think it's verbal intervention, but it is followed up by history in the sense that if oil prices or gas prices go higher, ultimately, it's going to cause the economy to cool and ultimately take those prices lower. And we've always seen OPEC has talked about the fact that if oil starts to go north of $80 per barrel, that starts to become more demand destructive. So I think they want to keep it in that type of range so they can continue to fulfill, with these higher prices. The other thing that's important is that when you look at where a lot of these problems are really emanating from, it's Europe, where you have a lot more constraints because they import a lot more oil. And if, in fact, it causes a lot more inflationary pressures, remember, Europe has a single mandate when it comes to the ECB, and it's inflation. And that could cause them to raise rates, which would ultimately slow their economy as well. So it is verbal intervention, but there is the fear that you could see some demand destruction if they do continue to move higher.
Alicia, build on that for us. Chris gave us the sector breakdown. I want to have a better idea of what the relationship looks like between the index and energy. Right now, there's some form of inverse correlation here on the S&P and energy. You see that playing out again this morning. Do you think that's something that persists?
Look, to the extent that energy prices remain above $70 a barrel WTI, I mean, don't forget the U.S. is now in energy, it's positive for U.S. GDP. It's no longer, the gas lines of grandpa or your dad in the 1970s. So that's actually bullish for energy stocks. And to the extent that energy is 3% of the S&P, should be positive for the S&P. I'll say this, going back to the comments about Europe, it is true that Russia created the problem by curtailing supply and is now going to help fix the problem by increasing supply. And that's very good, of course, for the Russian economy. So, yes, the natural gas issue has a solution. It is within the grasp, and the question is whether there's an incentive there for Russia to do so. The message really here, and it's really something for the U.S. to consider as we transition to a greener economy, is that a very fast transition to a new energy regime looks to be inflationary, as the desire to transition isn't quite in sync with the technology available to supply energy needs. And I think that's something that we need to think about as we watch Europe possibly going into brownout winters. And, the concern now is, will there be people on the streets in the places like Paris and beyond because the lights are turned out? So that is a real issue, and it's something that needs to be discussed here in the U.S. What is the speed with which we want to do this?
This is the broader fear. So every time we see higher gas prices, higher energy prices, whether it's Europe, China, or the United States, we start worrying about something else. Those higher prices hurting growth. And then you start to hear the S word more and more. Someone I really respect, Greg Jensen of Bridgewater, this is what he had to say at Bloomberg Invest on stagflation.
The problem is stagflation. That's the real risk. And so many portfolios are massively exposed. And there are ways to hedge that risk, to try to arbitrage that difference between the likely nominal outcomes and those available in financial assets today.
Larry Adam, I've voiced my frustration with the word stagflation many times on this program, so let's not go there again. But there's clearly a fear of it, Larry, and I'm trying to understand how this market responds to inputs like energy prices, what it means for broader risk appetite.
So again, I agree with you. I think that those fears in the United States are overblown. As I mentioned, I think they're more reasonable possibly to happen over in Europe. But I think when you look at what's happening from an inflation standpoint, which is what everybody's worried about, I think it is transitory. And I've been using the word it's transitory, right? So it's a little bit more elongated. But I still see it really starting to peak here in the sense that businesses are not standing by doing nothing, right? I mean, you've seen some of the news coming out with some of these companies like Costco, chartering ocean liners to help get their stuff here in a more timely fashion. If you look at some of the chip makers, some of the car manufacturers, they're bringing stuff to do here in the U.S. Companies are hiring, are giving bonuses, if you will, to existing employees, which, by the way, are more efficient to help their businesses. So I think businesses are doing everything they can to bring these prices lower. And by the way, the other side of this, people are seeing that the consumer is very frugal. There are a lot of surveys out there that are starting to show that as prices are moving higher, consumers are starting to balk. And businesses see that, and they're doing everything they can to bring that down. But I still think this economy is strong. We're going to have growth above trend. So I do think that stagflation warning that people are talking about is unwarranted right now.
Bank of America agrees. They say stagflation, no. Slowflation, yes. They say the following. This number just dropped. This piece from Bank of America. We believe slowflation is a better term for the higher inflation, slower growth risks we currently face. They go on to say inflation driven by commodity prices without an increase in labor costs generally cause the Fed to take a more dovish stance. Chris Harvey, can I get a final word from you, sir? Stagflation, slowflation. You're looking for 4,800 plus year end. What does this all mean to you?
What it means is, listen, with stagflation, you have to have a lack of demand. We don't lack for demand. When we talk to companies, when companies report, the one thing they say is demand is strong. The issue that we have right now is a supply issue. We're beginning to work through the supply issue. Tomorrow, as you point out, we'll get non-farm payrolls. If that's a big number, that's a large step into fixing the supply issue on the labor side. Ultimately, what we think and what we see is rates are low, credit spreads are tight, the economic wheels are not falling off the cart. What we've had is a duration repricing as rates have gone higher. We've had that adjustment, and now I think we're going to walk higher. And I think the earnings, or the earnings that we're going to see next week and as we move forward, are going to be better than expected.
Supply side story is just dominant, Alicia, going into that earnings season. Sometimes from the market perspective, I said this earlier, I'll repeat it, you don't need things to get better, you need them to stop getting worse. Do you think on the supply side they will stop getting worse?
Look, that's the big question out there. But as it relates to earnings, I think we've already seen the bulk of the earnings estimates come down for the third quarter and some reverberation into the fourth quarter. We probably have 1 or 2 more weeks of this. And then I think that's how the market stabilizes here, because ultimately we're not moving up in multiples as yields move higher, but we are going to be able to move higher with stronger earnings. So as the pre-announcements slow down, as you said, that's how we should put a floor under the market and ultimately move higher into the end of the year. I'm in agreement with Chris and Larry here that this is not an issue of demand. And as long as it's not an issue of demand, we can get through it. We do think the supply chains will open up. Commodity price spikes can cause temporary troubles in markets, but it's not permanent for the most part. And as we know, higher prices in commodities, the solution is higher prices in commodities. So this will equalize at some point, taking some of the heat out of the inflation scare. And that's why we also think ultimately transitory, longer than expected, but still transitory.
Transitory for longer, my favorite phrase. Alicia, thank you. Sticking with us, Alicia Levine, Chris Harvey, Larry Adam, sticking with us with equities rolling over just a little bit, still positive 0.8%. We're up 35. Coming up, President Biden warning Americans about the fallout from a debt default.
If it doesn't, we're going to be defaulting on a debt that would lead to self-inflicted wounds that risk the market tanking and wiping out retirement savings and costing jobs.
Down in D.C., they're kicking the can. That's next. This is Bloomberg.
Dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
We're making good progress. We're not there yet, but I hope we can come to an agreement tomorrow morning.
Senators nearing a deal on a short-term increase in the debt ceiling. Minority Leader Mitch McConnell saying the following: this will moot Democrats' excuses about the time crunch they created and give them more than enough time to pass standalone debt limit legislation through reconciliation. For more, down in Washington, here's Emily Wilkins. Morning, Emily.
Good morning. Well, we are still waiting the exact details of what this kick the can move, or punt the football if you'd like, because it might be right around Thanksgiving that we wind up dealing with this issue again. They're currently delaying it, which means that if they come to an agreement, we're not going to be defaulting on our debts on October 18th. But it sets up this debate for further down the road. We're still looking to see exactly what the details are going to be of this agreement that Mitch McConnell made last night and that Senator Chuck Schumer accepted in theory. Lots of remaining questions out there as far as how long this will go and how much it will be raised. But the standoff really is still there. Senator Mitch McConnell and Republicans have said that they are not going to be giving Democrats their votes to raise the debt ceiling for a long term. And they want Democrats to do so through the reconciliation process. Now, that's going to require that Democrats actually say how many trillions they want to raise the debt ceiling to. And that's something that Democrats, particularly Democrats facing tough races in next year's midterms, want to avoid doing. So the standoff is still very much still there. All that this solves is it takes off the immediate time crunch to get something done.
Emily, the senator from Massachusetts and the former president both said that the minority leader blinked. Do you think he blinked? Is that what people are saying in Washington? And if so, why?
There are people who are saying that McConnell blinked, and you could certainly make the argument that he did. He initially put his foot down and said this was Democrats to do, and now he's basically saying it's Democrats to do, but we'll give you until the end of November to do it. I mean, on the overall picture, this doesn't resolve a lot as far as exactly how this gets done. If you're Mitch McConnell, the one thing you don't want to do is have Republicans have their fingerprints on a long-term debt raise. If you're Senator Chuck Schumer, the one thing you don't want to do is have to have members raise the debt to a certain number. And at this point, both of those things, one of them is going to have to cave again. So this battle is really going to just continue on for whatever date that McConnell and Schumer decide to extend the debt limit to.
Emily, thank you. down in Washington on the latest. You don't want to hear what I think about this. This is what Evercore thinks about this. They think the debt limit standoff, the risks around it, they remain. This should diffuse the debt ceiling bomb for now. Democrats would again face the prospect of using reconciliation in December, which could trigger another standoff later in the year. That's their view. Here's Morgan Stanley's. They say, quote, should a default be priced into December now? We don't think so. This would be under the guise they will suspend the debt ceiling more permanently through reconciliation. Should you be concerned? Should you ignore it? Alicia Levine, Chris Harvey, Larry Adam. Larry, first to you, sir. Concerned or ignore?
So I think for the most part, I don't think you can ignore it, but I don't think that it's going to happen. I think brinkmanship is common down in Washington. I think with this new deal, it probably pushes this into early next year because remember, you know, it's going to go to early December, but because of extraordinary measures, that'll probably keep it funded until early next year. I think the bigger deadlines that are going to approach are going to be reconciliation. And then remember that at the end of this month, October 31st, that's when that surface transportation bill will need to be extended again. So there could be some ramifications around that time period. But I think Washington will still keep us a little bit on edge as we go to the end of this year.
Chris Harvey, your take, sir.
John, let's talk about the McConnell move. The first thing I would say is, in my opinion, that's a savvy veteran move. Some people have said it's an evil genius move because what did you do? You took this opportunity to, in simple terms, talk smack about the other side and tell everybody how great you are. But actually, what did you do? You've now forced them to have 2 votes. It takes a lot of time, organization, and energy to have 1 vote. Now you force 2. So you have less time to work on spending and tax. And that's exactly what the Republicans want. They want to run out the clock. And so I really want to focus on this because at the margin, if you're starting to reduce their opportunity to raise taxes, if you're starting to impinge on some of their spending, that's a positive. As far as the debt ceiling, yes, we will have to deal with this in December. In the short term, this is a small positive. This should alleviate a lot of the issues. But there are some underlying issues that we also have to talk about. And I think on McConnell's part, it was a pretty smart move. I wouldn't call it a blink. I would call it a savvy veteran move.
Chris, let's build on that. Alicia, do you agree that if the Democrats don't get what they want, ultimately that's a tailwind, a small one, for this market?
I'd have to say that we are worried about the fiscal cliff that we're in the midst of right now, and higher taxes and not as much stimulus next year would also be a deepening of the fiscal cliff. So to the extent that we don't have higher taxes eating into risk for capital or for on corporations, we do think actually that could be very positive for markets. Part of the reason we see a softening here is that the market is starting to price in higher taxes for next year in corporates. Now, granted, it is a one-time shift downwards in earnings. It's not continual. It's a one-time shift, and markets should get through it. But if you remove that risk, it's definitely positive for markets here. I think I have to agree with Chris here. I think it was sort of a three-dimensional chess move. And I'd say this, I think to the extent that it was made, it takes some of the heat and the acute pressure off the market and in the short-term funding market. And that's positive for markets as well, which is why you saw the reversal yesterday. It's a signal it's going to get done at some point, but in what way? And so that really is more positive for markets.
The biggest reversal since February of this year in this equity market. Alicia Levine, Chris Harvey, Larry Adam, sticking with us. Your equity market up 0.8%. Up next, the morning calls and later, strategists on this equity rally looking for more volatility. From New York City, this is Bloomberg. 5 minutes away from the opening bell in New York City. Off the high, still positive, up 0.75% on the S&P 500. That's the price action. Here are the morning calls this morning. Starting first up with Moffett-Nathanson, upgrading AT&T to neutral, seeing a compelling bull case following a long stretch of declines and underperformance. Your second call from Citigroup, downgrading Citrix to neutral, seeing a number of question marks after the sudden departure of the company's CEO. And finally, Wolf Research downgrading Bank of America to peer perform. The analyst warning that the stock's valuation has gotten ahead of itself. That stock's still positive, 44.79. Coming up, strategists seeing a volatile path into 2022. From New York, that's next. The opening bell just around the corner.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Thursday morning, good morning. About 20 seconds away from that opening bell in New York City this morning. Equity futures up 34, advancing 0.8%. You turned yesterday morning upside down from big losses to a decent advance on the S&P. The biggest reversal going back to February. That's the opening bell. Switch on the board and get to the bond market. Treasury set up as follows. Going into payrolls. Yields are drifting higher again by 3 basis points to 155. Crude's heading the other way. We're down 6/7% to 76.94. We had a little look yesterday at $80 a barrel. Just a look, didn't get there. 76.91 right now. At the FX market, euro just a touch weaker, down by 0.04%. Euro dollar 115.51. That's the cross-asset setup. Financials lead this morning, up 0.75%. On the S&P, we advanced by about 0.5%. At the bottom of the pile, utilities, but every single industry group on the screen right now in positive territory. There's a divide on Wall Street, there always is. Mike Wilson of Morgan Stanley on one side of it, looking for that 20% move potentially. I stress potentially. He says the following: we're now moving to downside factors that are more fundamental and persistent. We would reduce exposure to equities and high yield credit into the new year, then start to fade the rallies. That actually not from Mike Wilson. That right there, I believe, is from HSBC. Abigail Doolittle has more. Hey, Abby.
Hi there, John. Well, volatility certainly is the name of the game more recently, and it may make sense to reduce equities and high-yield credit given the trend. If you are a trend follower over the last month, stocks and credit both lower. If we take a look at the S&P 500, down nearly 3%, the NASDAQ 100, big tech really getting hit harder by rising rates, down 5%. And then if you take a look at high-yield credit and via an ETF, and even IG, corporate credit, down even more than high yield, down 1.2%. So again, this is the volatility that we've seen more recently. One reason to think it could build small cap. Small cap is often seen as a tell, a growthier tell, and last year and early this year, the most extended relative to the 200-day moving average ever. That's a fancy way of saying that markets got super frothy, more so than the last record back in 1983. Well, following that froth in 1983, there was a greater than 10% drop in 1984. We could be setting up for something similar this year. That could also be a tell on what we may see happen with big cap and credit. RVX, that small cap VIX, also rising. All of the vol indexes, in fact, John, rising, suggesting, again, there could be more volatility and downside for risk assets ahead.
Abby, thank you. Thank you very much. This from Barclays, weighing in on the impact of a Fed taper. They say the following: as policymakers unwind reflationary measures, growth and liquidity conditions won't get any better, and macro volatility should rise. But we believe final demand will stay firm as both corporates and the consumer are in good shape. Back with us, Alicia Levine, Chris Harvey, and Larry Adam. Chris, that's the difference here between a correction, calling for a 10 to 20% move, and the end of a bull market, something much, much worse. To believe that, I think you've got to believe we end up in recession. Can you help me with that distinction, please?
I think you're right, that what we expect is we expect this market to melt up. We expect typically at the end of a market, you have a lot more speculation, you have things that are uneconomic, you have irrationality. We're not there yet. I think we'll get there, but right now, this was just a correction. Going back to credit, the market issued more than $150 billion in September. And what did credit spreads do? They didn't widen, they tightened. That's telling you a lot. Recently, yes, there have been some volatility, but that's a very good sign. And again, going back to the constituents in the market, why did we sell off? We sold off because it was a long overdue duration sell-off. If you look at banks, you look at financials, you look at energy, it all rallied during that period. What happened was tech underperformed, and because tech is such a big part of the market traded down.
Chris, just want to jump in. We misattributed a quote on the screen to Mike Wilson of Morgan Stanley. It was actually from Max Kettner of HSBC, as I mentioned on air, but if you have the volume down, you might not have heard that. So let me just reiterate what Max Kettner of HSBC had to say. We're now moving to downside factors that are more fundamental and persistent. We would reduce exposure to equities and high yield credit into the new year, then start to fade the rallies. Larry Adam, can I get your thoughts on that line from Max Kettner over at HSBC, please?
So I agree that when you look at what's happened here more recently with the volatility, that was expected, right? It tends to be seasonally more volatile with some downside pressure during September and October. But let's keep in mind that October isn't necessarily completely always bad. In fact, if you look from October 10th till the end of the year, since 1990, we've been up on average almost 5% during that time period, and it's been positive 27 out of the 31 years. That's a pretty positive seasonal tailwind into the end of this year. And I think when you combine that with strong fundamentals, as you mentioned, the economy remains strong. I think earnings are going to remain healthy. If you look at shareholder activity, you continue to see increased dividends and buybacks. And I think valuations aren't as expensive as what people think if you factor in that we're likely going to see better than expected earnings. So I'm still pretty optimistic on this market through end of the year, and we have a target of 4,600 by the end of this year.
Alicia Levine, I think this resonates with you too. This line from Barclays that corporates and the consumer are in good shape still going into next year. Yes, the headwinds might be a little bit different, the tailwinds might be a little bit different, but ultimately the fundamentals remain the same. Corporates are strong, the consumer is strong. Is that your take, Alicia?
Yes, that's exactly right. We have a year-end target of more or less 4,700, give or take. But yes, we're positive into the end of the year, and precisely for the reasons you talk about. 70% of U.S. GDP is consumption. Household balance sheets are the healthiest they've been since the global financial crisis. So we've got very healthy balance sheets. We still have an extra $2 trillion in savings that has not been spent, and the service economy has not fully recovered. We're starting to see signs that the slowdown from the summer is reversing itself. So for these reasons, we think there's a tailwind, and some of those growth estimates that got pulled out of the third and fourth quarter are actually being pushed into 2022. Don't forget, earnings are nominal. So this fear about inflation will also be reflected in earnings, partly in a positive way as well. So, your earnings are not real, they're nominal. And so therefore, we're positive going forward. The risks are real. Let's not mistake it. And some of these supply chain issues, particularly out of China, could last longer, and that's where the risk is. But overall, as we stand here today, we think there's a couple more weeks of volatility, and then we can move higher into the end of the year.
Alicia, help me with the sector. Everything's green on the screen right now. Just to rattle through it quickly, the S&P up by more than 1%. Materials, discretionary, IT leading the charge here. Help me with the sector into the new year, Alicia. What do you like?
So I actually like earnings growers. And I like secular growers both in the cyclicals and in growth. And I think we, as investors, you can get too much over your skis choosing growth over value or value over growth. I'll say this, I think the street is set up for the fourth quarter for the cyclical trade and the value trade. So long financials, long energy, yields are moving higher. That may or may not be true, but in the last few days, I'll just point out that NASDAQ actually performed the Russell and some of those other sectors. So I think you have to focus on where the quality is and not so much those other style factors. You want earnings growers, companies that can earn through this. We are mid-cycle, we're not early cycle. So some of the more speculative names will not work here. The earners will, and that's what we like. So yes, parts of financials, parts of energy for sure with the tailwind, but also don't abandon growth here. And this is actually a great opportunity to get into quality names.
You mentioned that bit of outperformance on the NASDAQ. Again on the screen right now, Alicia. The NASDAQ up by 1.12%. The small caps, the Russell, up about 0.9%. Just a little bit of outperformance again there. Chris, Larry, I'd like to put the same sector question to you both. Chris, you first.
Okay. So, John, it really depends on your time horizon. Next couple days, next couple weeks, we think tech bounces. Tech is underperformed. It's underperformed because rates have gone higher. We think we get some, we think we get some stability here, and that helps tech really rally. You had a lot of these stocks down 5, 10, 15%, and you can see a pretty good pop. Longer term, we are also in the reinflation camp. We want more cyclicality. So that's financials, that's cap goods, and in technology, it's media and entertainment.
Larry, what about you, sir?
No, we like the cyclical tilt, although I do think you need to be a little bit more selective as we go into the end of this year. Just keep in mind that as energy prices have gone higher, I think you got to be careful with some of the industrials. For example, the airlines is a good example. Some of the consumer discretionary stocks, you might want to be a little bit more careful because of the rise in oil prices. And then if you think that the equity market's going to rally, I think you still have to like tech. And remember, techs, if you look at Tech Plus, which includes communication services and like Amazon, you're talking about 43% of the market cap of the index. And I think that those will continue to do well. I think what's underappreciated for a lot of these tech companies over the years is that they're not, the old tech companies where they just have a hardware or a software product. They're more diversified. If you look at some of these companies, they're not only tech companies, but they're communication service companies. They're consumer discretionary companies. They have exposure to transportation, financials, even healthcare. They're much more diversified than they've been in the past. And I think that that's going to continue to help them grow their earnings here for the foreseeable future.
The likes of Amazon has done absolutely nothing for me, for you, for the audience, for the whole year, up by 1.5%. Chris, can we finish there? Some of these big tech names, we're often so simplistic about tech. And to Larry's point, some of these names are so different, so exposed to so many different things. What do you make of some of the big names within tech?
Our opinion hasn't changed. If you're a big tech name and you fall more in the GARP camp, we like you. If you're a big tech name and you're growth at any price, not so much. And so in the short term, we're looking at things like NVIDIA. We're looking at situations like Cisco, things that have pulled back, but we think we can get comfortable longer term.
Chris Harvey, Alicia Levine, Larry Adam, it's been great to catch up with all three of you. Thank you, guys. Working through this opening bell about 10 minutes in. Equities advanced a little more than 1%. Top of the pile, materials, financials, discretionary. Financials doing nicely off the back of that move in the bond market. A little bit more defensive, underperforming this morning. Utilities, real estate, staples. Different to yesterday, it was a defensive rally. Top of the pile, staples, things like utilities. The other way around this morning, at least so far. Coming up, we head to China. More fundraising difficulties in the world's second largest economy. That'll be next from New York City. This is Bloomberg.
Surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Something wrong with her eye. And when I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The question isn't, should I be investing in that region or not? It's really, what's the best way and how should we be doing it? And in my mind, I think there's more opportunity in that region of the world than not, especially since valuations have corrected a bit in that part of the world.
Top investors seeing opportunity in China despite intensifying contagion concerns stemming from Evergrande troubles. Goldman less optimistic, writing the following: Fantasia's default raising the question whether funding difficulties amongst property developers are more severe than expected and whether other developers are in similar difficult positions. For more on this, Damien Sassower of Bloomberg Intelligence joins us. Morning, Damien. What is the latest? And I guess for many people, who's next?
It has been a week to forget, certainly for Chinese creditors, Jonathan. I mean, look, all eyes are going to be focused on this $260 billion jumbo fortune note, which had a 5-day grace period, which will end tomorrow. It just so happens that tomorrow is when China reopens after Golden Week. So it's going to be an interesting day in the markets, to say the least, overnight. I mean, look, just looking forward, I mean, we've got a couple other redemptions coming through for a couple other smaller property issuers. There's one on the 15th of October from Xinhua, 200 million odd payments. So, we're going to be focused on that, but all eyes are going to be squarely focused here on Evergrande heading into tomorrow. And look, we've got some data coming through over the better part of the next week out of China. Total social financing, credit. We saw reserves come in less than expected last night. So, we're looking for more stimulus out of China, expecting sub 4% growth in the fourth quarter.
Damien, from your perspective, what's driving things right now in EM more broadly? This story right here, or what's happening with energy prices?
I mean, well, for me, it's beyond both. It's going to be rates, right? We saw in the last 36 hours, Jonathan, 2 more central banks, surprise rate hikes, Romania and Poland. So Eastern Europe is catching a wind. To your point on energy prices going up, I mean, that's really the driver here. It's inflationary pressures. So 10 out of the 20 major central banks in emerging markets have now hiked rates since May. We expect more of the same going forward.
Damien, thank you on the latest in EM. What a fascinating moment for emerging markets. Damien talking about rates. When it comes to rates, it starts right here at home in America, in the United States Treasury market. Tomorrow, we get the September payrolls report. Forecasts are all over the place, anywhere from 0 all the way up to 750K, with your median 500,000. Mike McKee back with us. Mike, I want to spend some time on this with you going into tomorrow morning. Here we are looking at September payrolls, and the range is still 750,000 jobs wide. Why, Mike?
Because we're still trying to figure out what it takes to reopen an economy after a pandemic and you shut it down. Never happened before, and it has been confusing to people because we have the initial expectation was everybody would just come right back to work, but it hasn't happened. Took a long time to get people off of unemployment benefits. Moms have stayed home because of schools, and a lot of people are staying home working part-time. So we're not sure where we're going to end up on a month-to-month basis, since the seasonals that get involved in all these things are difficult to forecast as well.
Morgan Stanley trying to forecast it. The wonderful Ellen Zentner publishing this morning, Mike. They're looking for 700,000. They go on to say only a small downtick in the unemployment report is expected to 5.1%. That's the unemployment rate they're looking for, owing to a bump in labor force participation. Mike, can you get to your expectations beyond just the headline number, what you're looking for in the report itself, things like unemployment, participation, wages?
Well, you can take a look. I made a chart here of what we are expecting tomorrow. And interestingly enough, we are seeing a forecast for a slight bump in the participation rate up to 61.8%. That only came in yesterday. There's the forecast and how it compares with what actually happens. So you can see how far off we can be from that. But if we do get more labor force participation, that's going to make it harder to bring the unemployment rate down, but it will be good news overall for the economy. The unemployment rate is expected to tick down just a tick to 5.1%. So continued progress, which will probably make the Fed chairman happy.
So my big question, and if I asked a couple of economists about this, I'll get different answers. I'd love to hear what you've got to think about it. The labor market in America right now, tons of slack or super tight? Which one is it?
That depends on labor force participation, and that's the problem. Is some people like Jim Bullard of the St. Louis Fed are looking at labor force participation, the fact that not a lot of people are out there in the labor force to get all these open jobs, and saying the labor force is tight. Others believe that we're going to pull people back in as the economy continues to open up and some of the problems start to go away, and that will mean that we're not in a tight labor market. And you look at the overall number of jobs, some 8 to 10 million still open. The Fed is at this point in consensus, if not in complete agreement, that the labor market is still relatively loose.
This is tough, isn't it? We're going to jump from October 8th tomorrow straight to November 3rd, which is the Fed's next meeting. And Mike, that's the big question. If we don't know the answer to that conclusively, and we might not know anytime soon, how do you set policy for that?
Well, you just do your best. We aren't going to have the October payrolls report by the time of the November Fed meeting. It comes the Wednesday before the payrolls report comes out. So they're going to have to work with what they've got and the other indicators like claims and ISM and ADP and all of that to try to figure out where the labor market is. But we will make one stop along the way, one market stop, John, before we get there, and that'll be the CPI report.
Yep.
Because everybody's going to want to know if transitory is still transitory. That comes up in the middle of the month.
Transitory for longer. Yeah. How frustrating is that, Mike? Honestly, Michael McKee, Thank you. The S&P advancing a little bit more than 1% this morning, about 20 minutes into the session. Everything in the green. Every single industry group led by materials, discretionary, financials. Financials up by 1.2%. The bond market participating there as well. Building on the sector price action, I'm pleased to say our stocks editor is with us, Dave Wilson. Hey, Dave.
Hey, John. I mean, you've already kind of captured the highlights, but beyond that, what's interesting is you've got a split among the commodity producers. As you mentioned, materials, the best performers among the 11 main industry groups in the S&P 500. On the other hand, energy kind of trailing the pack a bit as crude oil prices fall. And then you have utilities as the worst performers among the 11 main groups. And while they're all green, well, you can't say that across the market. One area where you're not seeing green at this point is in the food industry. We had a couple of fiscal first quarter earnings reports out today, one from Conagra Brands, which went over okay, but the other one from Lamb Weston. You know, they provide frozen French fries and other potato products, and those numbers didn't go over well at all. I mean, earnings and sales coming up short of analyst average estimates in the Bloomberg survey. Lamb Weston down more than 8.5%, dragging down the group, which set a record back in June and has been struggling to rebound ever since. Had been higher the past few days, but today you got Lamb Weston dragging down the S&P 500 food processors.
The S&P more broadly, though, looking good. Dave, our stocks editor, will drive you through the price action and through the market day on Bloomberg TV and on Bloomberg Radio. 22 minutes in, we advance a little more than 1 full percentage point on the payroll story. 500K, the median estimate. The range anywhere from 0. That one that right there is from Mr. Kosterg at Pictet, all the way up through 700. 700K, the view from Morgan Stanley and Ellen Zettner. Tomorrow on Bloomberg Surveillance, we'll catch up with both of those views, the 0 and the 700. And then later after the number, 9 a.m. on this program, I call it the best lineup anywhere on business TV, worldwide, on payrolls. Mohammed Al-Arian of Bloomberg Opinion, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital Network, and Michael Collins of PGIM, all with us through the hour tomorrow morning. Do not miss that. From New York City this morning, good morning. Your equity market building on the gains of yesterday. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Attempts to revise frameworks for monetary policy, average inflation targeting, just out of the window, basically, because the idea that you can gradually control inflation to let it go above target a little bit for a short period and then bring it back doesn't square with what happens in the real world. So I think being alert to the data Some of the upward pressures will be transitory, but the real risk is that it gets embedded into upward pressure on wages. That's going to be the thing that central banks will focus on.
Always nice to hear from a former central banker. They speak a little bit more openly. The former Governor of the Bank of England there, Mervyn King. Here's the equity market advancing a little more than 1% on the S&P, up by 1.42%. On the Russell, on the Nasdaq, we're up by about 1.28. That's the price action. Here's the trading diary. Coming up through the day and into next week, Cleveland Fed President Loretta Mester speaking on a panel, 11:45 Eastern. Then President Biden discussing vaccinations at 3:45 this afternoon. Rounding out the week with the main event, the U.S. payrolls report on Friday. Next week, earnings season begins. JP Morgan on Wednesday. We'll get US CPI numbers on Wednesday as well. So a lot to get our teeth into next week. From New York City, for our audience worldwide, I'll see you tomorrow for the payrolls report. Thank you for choosing Bloomberg TV. This was the countdown to the open. With your equity market rallying 1.2%, this is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. and filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has coming here yet. So we need a refill of this medication. After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.